Please like, share, and subscribe. Wishing you happiness and good luck every day.
Algorithmic trading. It sounds so complicated, right? Kind of like this black box that only math geniuses can unlock. But what if I told you the key to winning wasn't some secret, complex formula, but actually a really disciplined approach to simple, powerful ideas? Well, today, we're going to break down the core principles for building a strategy that actually works, drawing from the hard-won insights of veteran trader Perry Kaufman.
So let's kick things off with a little thought experiment from Kaufman himself. Imagine a coin comes up heads 99 times in a row. A statistician will tell you the odds of the next flip are still 50-50. But a trader? A trader says the chance of it being heads again is 100%. Why? Because after 99 heads, it's obviously not a fair coin. That right there is the mindset we need, one that's grounded in reality, not just pure theory. Because in the markets, experience is everything.
And really, the big idea that's going to guide us through all of this is simplicity. Believe it or not, the most durable, long-lasting trading strategies aren't the most complicated ones. They're the ones built on a simple, fundamentally sound idea, and that's exactly what we're going to focus on.
All right, so this brings us to our first pillar. You have got to start with a simple idea. Here's a good rule of thumb. If you can't explain the logic of your strategy in just a sentence or two, it's probably way too complicated to work in the long run.
See, you can't just throw a bunch of random indicators at a computer and hope it spits out gold. That's a classic trap called overfitting. All you've done is found a strategy that perfectly explains the past by pure chance, but has absolutely no predictive power for the future. The core concept has to be logical, something you can actually explain.
So what does a sound idea even look like? Well, it could be something as straightforward as following a trend that's being driven by central bank policy. Or maybe exploiting clear seasonal patterns, like natural gas prices tending to rise in the winter. Even something like pairs trading, where you're basically betting on the relationship between two similar companies like Coke and Pepsi. It works because it's based on an observable market behavior, not just random noise.
Okay, so you've got your simple idea. Now comes the hard part, and honestly, the most critical goal of this whole process. You have to make sure it's robust. This one concept is what separates a lucky backtest from a legitimate, tradable strategy.
So here's the deal with robustness. A robust idea isn't a one-trick pony. It's not perfectly tuned to one stock in one specific year. It's a concept so fundamentally sound that it works across totally different markets and different time periods, all while using the exact same set of rules, no exceptions.
But that's the key question, isn't it? It's one thing to define it, but actually seeing what it looks like, well, that's what makes it all click.
Okay, take a look at this chart. What we're doing here is testing a simple trend strategy on two different things, the S&P 500 and Apple stock, using a whole bunch of different parameters. Now, your first instinct might be to look for the single tallest bar, right? Don't. That's just the luckiest outcome. Instead, look at how almost every single bar is profitable, above that zero line. That consistency, that smooth sea of green, that's robustness.
What you're really looking for is that smooth performance. If you change one tiny detail, like, say, the length of a moving average, and your results suddenly swing from a huge profit to a huge loss, well, your idea is just too fragile. It's not robust. You're hunting for stability.
And this right here is the ultimate test. On the left, you've got US bonds. On the right, crude oil. I mean, these markets could not be more different. One is driven by interest rates, the other by geopolitics and supply. Yet look at the similar patterns of profitability. When your basic idea works on assets that are this diverse, you know you're onto something real.
So, the million-dollar question is, how do you actually find these robust ideas? Well, it's not guesswork and it's not luck. It's all about following a structured, disciplined development process. So let's walk through the steps.
The process itself is pretty straightforward. You start with your idea and you get your data. You program the rules and then you test them on your main data set. That's what we call the in-sample test. After you evaluate those results, you move to the single most important step, the out-of-sample test. This is where you unleash your strategy on data it has never ever seen before. If, and only if it passes this final hurdle, are you ready to actually trade.
And this is where discipline is absolutely everything. If your strategy fails that out-of-sample test, you can't just go back and tweak the rules to make it work. Why? Because you've already seen the data. You've basically given your strategy the answers to the final exam. The only honest, and I mean only, thing to do is to throw that idea in the trash and start completely fresh. It's brutal, but it's the only way you don't end up lying to yourself.
Okay, so we've covered the core pillars: a simple idea, a robust strategy, and a disciplined process. Now, let's use that exact framework to challenge and maybe even break one of the most sacred rules in all of trading.
I mean, everybody says it, right? Always use a stop loss. Cut your losers short and let your winners run. It seems like the most basic rule of risk management there is. But is it always true?
Well, the expert advice from Kaufman might be a bit of a shocker. For one of the most popular styles of trading out there, trend following, he says using stops and taking profits early can actually destroy your strategy.
So why on earth would this make sense? Well, think of it this way. A short-term trader is like a rabbit. They're trying to make a lot of quick, small hops, grabbing little profits and avoiding danger at all costs. But a trend follower, they're trying to climb a mountain. They know there are going to be dips and valleys along the way. Their entire strategy is built on capturing that one massive, unpredictable climb all the way to the summit.
Think about it. A typical trend-following system is only profitable on maybe 30% of its trades. It pays for all those small losses with just a few enormous wins. So if you use a stop loss, you are literally cutting yourself off from the very possibility of capturing that huge, system-making profit. You are guaranteeing you can never hit the home run that your entire game plan depends on. It's like leaving the theater minutes before the incredible plot twist you've been waiting for the whole time.
And really, that's what this all boils down to. The key isn't just to have a set of rules. It's to deeply understand why a rule exists and whether or not it actually aligns with your strategy's ultimate goal.
So, if you walk away with anything from this, let it be these 3 pillars. Number 1, start with a simple, sound idea. Number 2, test it relentlessly for robustness across different markets and different time frames. And number 3, follow a disciplined, honest development process every single time.
This is how you really begin to transform theory into reality. So the question I'll leave you with is this. Now that you're armed with this framework, what piece of common trading wisdom will you question next?
All right, let's dive right in. Today, we're going to cut through all the complex theory and give you a straight-up, real-world guide to building an algorithmic trading strategy. We're going to focus on the crucial steps, the ones you usually only learn from experience, often by getting them wrong a few times first. So let's get to it. To really set the stage, I want to start with a classic anecdote that just perfectly captures the difference between theory and practice in trading. So picture this. You flip a coin 99 times, and it lands on heads every single time. You turn to a statistician and ask, what are the odds it's heads on the next flip? Relying on pure probability, they'll say 50-50. But then you ask a trader the same question. What do you think they say? The trader says 100%. So why the different answer? Well, it's simple. In the real world, a coin that lands on heads 99 times in a row isn't a fair coin. It's almost definitely rigged. And that's the whole point, right? Successful trading isn't just about the math. It's about recognizing when the reality of the situation is different from the textbook theory. Okay, before we get into the nuts and bolts of building a system, we need to lay down some ground rules. Think of this part like packing the right gear before you start a long journey. These are the core ideas you just have to accept before you even think about writing a single line of code. The whole point here is to give you what the source material calls a painless lesson in reality. We're skipping all the fluff, we're focusing only on the most critical parts of the process. This is all about learning from the most common mistakes right up front, so hopefully you don't have to make all of them yourself. Now, one of the things I really appreciate about this source is how honest it is. The author comes right out and admits their own biases. For example, they prefer fully automatic trading, they like systems that follow big, long-term trends, and they're pretty suspicious of anything that's overly complex. And this is such a crucial point. Every single developer has their own biases. Acknowledging them is the first step toward building something that's actually objective. All right, with those ground rules set, let's get to the main event, the official roadmap. This is really the heart of it all, a structured, step-by-step process for taking a trading strategy all the way from a simple idea to actually executing it live. So here it is, the entire journey laid out in one flowchart. As you can see, everything starts at the top with an idea. From there, you move down. You gather your data, pick a platform, and then you program your rules. After that, you hit the really critical testing phase. If the results look good, you keep moving forward. But if they're bad, you hit that first loop over on the left. You go back, you change the rules, and you try again. This little cycle right here, that's where all the real work and refinement happens. So the beginning of this process is pretty straightforward, right? It all starts with your big idea. Then you've got to gather all the historical data you're going to need to actually test it. Next up, you pick a testing platform. This could be anything from a simple Excel spreadsheet to some really sophisticated software. And finally, you get to the fun part, defining and programming the actual entry and exit rules for your strategy. Okay, so you've done all that work. You've programmed your rules, and you've run your first test on what's called in-sample data. That's just the historical data you use to build and train your system. And now you've hit the first major fork in the road. The test spits out some results, and you have to ask yourself the really tough question, are they actually any good? Now, if the results are bad, you hit that first feedback loop we saw on the flowchart. And you know what? That is completely normal. In fact, you should expect it. You don't just throw the whole idea in the trash. No, you just go back, you tweak the rules of it, and you test it again. You stay in the cycle of refinement until you get results that you're happy with. But what if the results look good? Awesome, that feels great. But now you move on to what is, without a doubt, the most critical stage of this whole process, the out-of-sample test. This means you test your shiny new strategy on a completely fresh set of data that it has never seen before. This is the real moment of truth. This is how you find out if your system actually works or if you just got lucky with your first data set. So that smooth, happy path we just described, yeah, that's rarely how it goes down. In the real world, you almost always end up taking a detour. So let's talk about what happens when you get lost, which, spoiler alert, pretty much everyone does. Here's the cold, hard reality check. That out-of-sample test is where most promising systems just completely fall apart. It's so common. You've perfected your rules on one set of data, but the second you introduce new, unseen data, the performance just tanks. This right here is the moment of truth for your idea. Now, according to the purists, the people who follow the scientific method by the book, the answer here is clear. If your strategy fails the out-of-sample test, the experiment has failed. Period. You are supposed to throw the whole system out and go all the way back to the beginning with a brand new idea. But, as our source so bluntly puts it, that never actually happens. And why not? Because we're human, we're biased. We fall in love with our own ideas. We convince ourselves that the system basically works, we just overlook something. So instead of starting over like we should, the temptation is to cheat, to go back and tweak the rules based on the test data we just saw. So what do you do now? Well, the very moment you use that test data to change your rules, that data is contaminated. It's no longer a valid test. You've completely lost your independent verification. The only way to get back on track is what the author hilariously calls your punishment, paper trading. You now have to run your system in a simulation with no real money on the line for a long, long time, just to prove it actually works. So let's just assume you survived this whole process. You've navigated the loops, you've faced the brutal reality of testing, and you've made it through. What's the destination? After all that work, what kind of trading systems do people actually end up building? Let's take a quick look at the two main types. You're likely going to end up with one of two things, a trend system or a short-term system. Trend systems are usually simpler. Think of something based on moving averages, like it buys when a short-term price average crosses above a long-term one, signaling an uptrend. On the other hand, short-term systems can be way more complex. They're designed to catch really quick price movements, often based on specific chart patterns or breakouts that happen within a single day. And that pretty much brings us to the end. We've walked through the entire roadmap, from that first little spark of an idea all the way to the messy, complicated reality of testing and validation. The process itself is clear. So the final question really isn't about the steps on the slide. It's about you. Do you have the discipline to actually follow them, especially when it gets tough?
Hey everyone, and welcome. Today, we are going to tackle one of the biggest questions in trading. Where do really profitable trading ideas even come from? We're not talking about get-rich-quick schemes here. We're going to build a framework for a strategy that actually has a real fighting chance, and it's all based on principles that have stood the test of time. So let's just jump right in with a question that I think tempts every single trader, whether you're new to this or you've been at it for years. Can't we just, feed a super powerful computer a ton of indicators and patterns and all this historical data and just have it spit out a money-making machine? It kind of seems logical, doesn't it?
Well, the answer to that is pretty blunt, and this quote just nails it. The big problem with this whole brute force approach is something called curve fitting. What you're really doing is just forcing a pattern onto old data. Sure, it might explain the past perfectly, but because it doesn't have a real-world logical reason behind it, it's pretty much useless for figuring out what's going to happen next.
And that idea, it leads us right into our first big topic, the backtesting trap. This is where that whole curve-fitting thing gets so dangerous. It's a massive pitfall that so many traders fall into, thinking that a flawless backtest is the holy grail. But in reality,
So what's the big takeaway here? The myth is that a profitable system is some kind of complex secret, a code that only a powerful computer can crack. But the reality is, a strategy that's born from a black box, with no real intuitive or logical reason behind it, well, that's a strategy built on sand.
Okay, so if a computer can't just build it for you, where do winning strategies actually come from? The answer is surprisingly simple. It all starts with what we call a sound premise, an idea that you can easily explain, something that's rooted in a logical belief about how the market actually works.
And these premises, they're not some crazy complex algorithms. They're just observations about real-world market behavior. I mean, take seasonal patterns. We all know heating oil demand goes up in the winter. That's a sound premise. Simple. Or think about stock arbitrage. That's just the idea that two very similar things, like say two giant home building companies, should probably trade at similar prices. So when they drift apart for no good reason, hey, there might be an opportunity. The key is that these are all ideas you can explain in a single sentence.
So, you've got a sound premise? That's awesome. But guess what? That's only half the battle. The idea also has to fit you. It has to fit your unique personality.
And this quote, man, it really says it all. Don't fight your nature. You'll lose. Think about it. If you're an impatient person, a slow, long-term strategy is going to drive you absolutely crazy, and you'll probably end up sabotaging it. If you hate stress, a high-frequency system that's all about tiny, rapid profits, scalp trading is just going to burn you out. You just can't force a strategy that goes against who you are.
This is illustrated perfectly by this little story about a husband and wife who are both traders, but they're polar opposites. She's a former floor trader, super fast, in and out, and she sees any small drop as a major catastrophe. He, on the other hand, is an investor, focused on the bigger picture, longer time frames. You've got two completely different trading personalities living under one roof.
And here's the proof. So after the 2008 crisis, they both agreed on this long-term investment plan. But just a few days later, his wife comes to him with this Cheshire cat grin because she'd already sold everything for a quick profit. She just couldn't fight her nature as a short-term trader, even when her logical brain told her otherwise.
So the lesson here is crystal clear. You have to be honest with yourself. Are you built for speed or are you built for endurance? Find a strategy that feels natural to you, not one that feels like a constant uphill struggle. You have to work with your instincts, not against them. All right, next up is a major reality check. We have got to talk about expectations. Specifically, this really dangerous idea that trading can provide you with fast, consistent income right from day one.
Let's look at this perfect real-world example. A guy has $50,000 in trading capital, and he needs to pull out $2,500 every single month just to live. That sounds like a whole lot of pressure, right?
Well, let's just do the math. To pull out $30,000 a year from a $50,000 account without even touching the principal, he needs to generate a 50% annual return year after year. And that is, to put it mildly, very unrealistic. The far more likely outcome is that the account just bleeds out over time. So the crucial point is this. You have to treat your trading capital like a long-term investment, not like an ATM. Even the best systems in the world have losing years. If you're forced to withdraw money during a natural downturn, you're basically crippling your ability to ever recover and grow. This brings us to our final and maybe most crucial section, finding ideas that actually last. How can you tell the difference between a durable, long-term concept and just a temporary fad that's going to disappear next month?
Let's look at an example of a durable idea. The whole concept of trend following, buying things that are going up and selling things that are going down, that has been a profitable foundation for strategies for decades. The logic is timeless. Sure, it might get more competitive, but the core idea, it endures.
Now contrast that with a flavor of the month strategy. So there's this trader who noticed a temporary pattern where a huge institution was buying crude oil every single day, right before the market close. He exploited it, made a nice profit for about a month. And then, just as suddenly as it appeared, poof, the pattern vanished.
But, being durable doesn't mean being rigid.
Even great ideas need adjustments from time to time. For example, an intraday breakout system started to fail as the market volatility changed, but the solution wasn't to scrap the whole idea. It was a small tweak, just holding the winning trades a little bit longer, a minor change that preserved the core profitable concept.
And this all brings us to the ultimate takeaway. The best trading ideas, they don't come from some computer algorithm. They come from you. They're born from being observant, from noticing patterns and inefficiencies in the market, and from having the courage to actually go out there and test your ideas.
So I'll leave you with this final thought. Stop searching for the perfect combination of indicators on a chart. Instead, start observing the world around you. What market behaviors or seasonal shifts or repeatable human reactions have you already noticed? The next great trading idea isn't hiding in some black box. It's waiting right there for you to see it. The only question is, what will you start looking for?
All right, let's just jump right in. We're going to talk about a massive trap that so many of us fall into. And I'm not just talking about trading. This is everywhere. It's that urge, to make things, well, complicated. And here's the thing, right? We have this idea that complexity equals sophistication, that if something's really intricate, it must be smarter. But this quote, it just nails it. Complexity is not sophisticated, it's just confusing. At the end of the day, it's a recipe for confusion and, usually failure. So let's really dig into that idea. Our first stop is what we're calling the complexity trap. What is it about this trap that makes us walk right into it time and time again? Yeah, this really breaks it down, doesn't it? So why do we do it? Well, for one, it feels smarter, more sophisticated. We also try to plan for every single possible thing that could go wrong, right? To avoid any loss. I mean, we've got these powerful computers, so why not? The problem is you end up with a system that has way too many moving parts. And when it breaks, and believe me, it will break, good luck trying to figure out what went wrong. It's basically impossible to fix. Okay, so if that's the trap, how do we get out? What's the escape plan? Well, it's all about a big mindset shift. We need to stop trying to build something that looks perfect on paper and instead focus on building something that's truly robust. And I gotta say, I love this analogy from a fund manager that's mentioned in the source. Loose pants fit everyone. Just think about that for a second. Are they perfectly tailored? Nope. Are they the absolute best choice for a fancy dinner party? Probably not. But you know what? They work pretty well in a whole bunch of different situations. That is the essence of a robust strategy. So here's the trade-off, laid out right in front of you. On one side, you've got your robust, loose pants system. It works in a lot of different markets because the core idea is solid. It knows you're going to take some losses. That's part of the game. But it's simple. You can understand it. On the other side, that's the temptation, isn't it? The perfect-looking system. It looks incredible on past data, but it's so fragile, so complex. And because it's built on the impossible idea of never losing, when it finally does break, it doesn't just bend, it shatters. So let's just be super clear here. What do we even mean by robust? Well, in this world, it means a strategy that holds up over a long, long time and in a bunch of different markets. And here's the most important part. The reason it works isn't some lucky accident that fit the past. It works because there's something fundamentally right about the idea behind it. Okay, that's the theory. But how does this play out in the real world of markets? To understand that, we're going to use another brilliant analogy. Get ready for the drunken sailor's walk. Now, before we get to the sailor himself, you need to know what he represents, and that's something called price noise. All that means is the random, unpredictable, day-to-day jiggles in price. Just think of it like static on an old radio. It's the stuff that makes it hard to hear the actual song. Okay, got it? Noise is the random static. Now, let's bring in our sailor. I want you to picture him making two very, very different trips. First up, you have the sober walk. This is the sailor heading to the pub. He's on a mission. He walks a perfectly straight line. It's direct, it's efficient, no wasted steps. But then there's the journey back, the drunken walk. And, well, you can imagine. He's staggering all over the place, stumbling down one alley, turning back, lurching down another. He gets back to the ship eventually, but his path is messy, inefficient, and totally unpredictable. And this is where it all clicks into place for trading. That sober walk, the straight, efficient, low-noise path, that's perfect for trend following. That's when you're betting that a price will just keep going in the same direction. But the drunken walk, with all that high-noise staggering, that is tailor-made for what's called mean reversion. That's the bet that the price, no matter how far it wanders, will eventually stumble its way back to the average. And you gotta know which walk you're dealing with, because if you try a trend strategy on a drunken sailor, well, you're gonna lose your shirt. Okay, so we get the what. We want robust systems that match the walk of the market. Now let's get into the how. How do you actually build one of these things? This brings us to a really important idea. Are you using building blocks, or are you just throwing everything into a blender? So you've really got two ways to go about this. The first is the building block method. It's methodical. You test every single rule one by one, and a rule only makes it into the system if it's actually profitable all by itself. It's clean, it's simple, you know why every piece is there. Then you've got the blender. This is where you just dump all your ideas in at once, hit puree, and hope the computer spits out some magic formula. The huge risk here is that you've got a bunch of losing ideas that only look like they work together, creating this tangled, confusing mess that's just waiting to fall apart. And this is exactly why the source material pushes so hard for building blocks. You know every single piece works on its own. You get the logic. So if your performance suddenly takes a nosedive, you can pop open the hood and see exactly which part is failing. The source makes a really chilling comparison here. That blender approach, that's basically the same kind of thinking that led to the impossibly complex, interconnected mess of the 2008 financial crisis. You want the complete opposite of that. You want something you can actually understand and rely on. All right, this leads us to our final section, and it's a huge warning. This is about the ultimate danger of making things too complex. It's time for us to meet the overfitting octopus. So what on earth is overfitting? Simple. It's when you keep adding rules and tweaking your strategy until it perfectly explains everything that happened in the past. I mean, it looks brilliant on your charts. The problem? It's been so perfectly tailored to what's already happened, it has almost no chance of working in the future. Because the future is never exactly like the past. And the image of an octopus with too many legs is just perfect. Imagine you keep adding another leg, another rule, to grab onto every tiny little profitable moment from the past. Before you know it, you've got this clumsy creature with 1,000 legs, tripping all over itself. It's completely unable to adapt when the world around it changes just a little bit. So why is this so dangerous? Why can't you just solve for every problem you've seen? Because market risk isn't some puzzle you solve once and you're done. No, it's way more like a frantic game of whack-a-mole. You know how it works, right? A problem, a mole, pops its head up. And we, the system builders, we grab a mallet, a new rule, and we smash it down. But what happens next? A totally new, totally unexpected problem pops up somewhere else. The big takeaway here is that you can't get rid of the moles. Crises and crashes are gonna happen, and trying to add a rule for every single one that's ever appeared is a losing battle. It just makes your system more complicated and easier to break. So let's zoom out for a second. This whole idea, don't make it complex. It's so much bigger than just trading. This is about how we solve problems, how we design things, how we make decisions in our everyday lives. And that really brings us to the final question, the one I want to leave you with. Take a look at your own life, your own work. Where are you choosing complexity when simplicity would do? And what is that choice actually costing you? You know that trader, right? The one who only trades Apple? They know every product launch, every earnings call. They feel like they can't lose. But what if I told you that laser focus is actually their biggest weakness? Today we're going to tear down that just Apple fallacy and show you what the real secret to long-term trading is all about. I mean, it sounds logical, doesn't it? If you spend all this time mastering one single stock, inside and out, why would you bother with some big, complex system? It's a really tempting idea, but it's also a dangerous trap. And understanding why it's a trap, well, that's the key to surviving in this game long-term. Think of it like this. A strategy that only works on one stock? That's a house of cards. Sure, it might look impressive for a bit, but one bad earnings report, one unexpected gust of wind, and the whole thing comes crashing down. A pro, on the other hand, they build a fortress, something with a solid foundation that can handle whatever the market throws at it. And that foundation, that's a little something called robustness. All right, so let's really dig into this idea, robustness. Now, this isn't just some fancy buzzword. It's the absolute core principle that separates a lucky amateur from a skilled professional. This is their secret weapon, their edge. And I promise you, understanding this is going to completely change how you look at trading strategies forever. So what is it really? Well, here's the big idea. A robust strategy, it isn't a key that only fits one very specific lock, like, say, Apple's insane bull run back in the day. Nope, it's more like a master key. It's designed to unlock a fundamental behavior of the market itself,
like the fact that prices tend to trend. And you can find that behavior pretty much anywhere, anytime.
And this is where it gets really powerful. Okay, look at this. On the left, you've got a simple trend following strategy running on stocks. And on the right, that's the exact same logic, the same rules, but applied to interest rates. Now, just look at those charts. See all that blue? See how almost all of those bars are sitting above the zero line? That's profit. We're talking two completely different worlds, stocks and bonds, but the core idea works on both. That is robustness in action. And here's something that might surprise you. You don't need a perfect score. Not even close. If you test your strategy and it's profitable in, say, 70% of the cases across different markets and settings, that's not just good, that's incredible. It's a huge sign that you're onto something real. So, how do we actually do that testing? Okay, so how do we actually figure out if a strategy is robust? How do we find that 70% sweet spot? Well, it all comes down to testing. But listen, it's not just about running the numbers. You have to know what a good result looks like, and maybe even more importantly, what a bad one looks like. So let's break down what you were actually seeing in those charts. We were testing a super simple idea. Just follow the trend. But we tested it using a bunch of different speeds, right? Sometimes reacting really fast to price changes, and other times taking it nice and slow. The goal was never to find one single magic number. It was to see if the basic idea held up, no matter the speed. And that sea of blue we saw, that tells you the answer is a huge resounding yes.
Okay, that's the good stuff. But it's just as critical to know what a bad result looks like. How can you spot a strategy that's basically a ticking time bomb just from a chart?
This is what you run away from. You see this? A massive win, then a little one, then a loss. This crazy roller coaster ride is a giant red flag. It's screaming that the strategy isn't based on a real market principle. It's what we call overfit. All that means is it was perfectly, and probably accidentally, tuned to the random noise of the past. A truly robust strategy, it should look way smoother, way more consistent as you tweak the settings. All right, so you've done the work. You've tested your idea, you've confirmed it's robust, you're feeling good, but now comes what is honestly the most dangerous part: deciding which version to actually trade. Because right around this corner, there's a huge psychological trap just waiting for you. I mean, this is the million-dollar question, sometimes literally. You run, say, 100 different tests. A bunch of them did okay, some did pretty good, and one of them just absolutely crushed it, knocked it out of the park. So, which one do you trade? It's obvious, right? You pick the winner. But here's the twist. A pro knows that the #1 top performer, the one that looks way too good to be true, probably was too good to be true. It was just lucky. It got curve fit to the past, meaning it accidentally caught every random up and down just perfectly. And expecting that same lightning to strike twice, that is a recipe for disaster. The big takeaway here is, you never ever chase the best looking result. So, if you can't pick the best one, and you obviously don't want the worst one, what in the world are you supposed to do? The answer is simple. You don't pick just one. The professional approach is to diversify your parameters. Think about it like you're building a small sports team. Instead of betting everything on one superstar player, you trade a few different versions of your system all at the same time. Maybe a fast one, a medium one, a slow one. A good rule of thumb is to trade at least 4. And this really gets to the core of the professional mindset. What you're doing is intentionally giving up the chance to hit that 1 in a million lottery ticket result. But in exchange, you get something so much more valuable: stability. You're trading that crazy high peak for a much smoother, more predictable ride. Okay, and that brings us to our final and maybe our most important point. We've talked a ton about finding a robust method. But what if I told you the method you choose isn't even the most important part of the puzzle? Okay, I want you to look really closely here. On the left, we've got US bonds. On the right, crude oil. Now, on each of those, we're testing 3 totally different ways to follow a trend: a moving average, a breakout system, and a linear regression system. 3 different engines. And yet, just look, within each market, the overall shape of the profit curve, the ups and the downs, they're almost identical. So what does that tell us? It tells us that the specific boat you're in is less important than the current of the river. Think about it. When the market is trending hard, the river is flowing fast, and pretty much any trend-following boat is going to float downstream and make money. But when the market is just chopping sideways, the river's not moving, and all the boats are just going to be stuck struggling. The market is the current, your method is just the boat. Now, that said, different boats do handle the water a little differently. A moving average system, that's kind of like death by 1,000 paper cuts. You get a lot of small, nagging losses. A breakout system, on the other hand, you have fewer losses, but when you do lose, man, some of them can be deep gashes. So the choice isn't about which one is better. It's about being honest with yourself and asking, which kind of pain can I handle better? All right, so let's tie this all together. That just Apple idea, it's a trap, plain and simple, because it confuses pure luck with actual skill. The real edge, the real skill, comes from robustness, finding a strategy that works across all kinds of markets and times. And to do that, you have to fight the urge to chase that one perfect result. Instead, you build stability by trading multiple versions at once. Because at the end of the day, your success isn't really about your specific method. It's about being in the game and ready to go when the market gives you that big, strong current to ride.
And that leaves us with one last thing to think about. This whole idea of robustness, choosing consistency over that spectacular, flashy win. It's a really powerful way to think, and not just in trading. So my question to you is, where else in your life could you apply this? Where could you trade the chance for a single perfect home run, for a solid foundation that's built to last for years? It's something to think about.
In trading, there's this constant pressure, right? You feel like you always have to do something, make a trade, chase a trend, just be in the action. But what if, and this is the big idea, what if the real secret to better returns is actually doing, well, less? So let's kick things off with a question that might sound a little out there. Is it possible that the single most profitable trade you could ever make is the one you choose not to take? It sounds backward, I know, but today we're going to dig into a strategy that completely flips that old school thinking on its head.
All right, so before we can really get why less is more is so powerful, we have to talk about a problem, a big one that pretty much every trader runs into. We're calling it the trader's dilemma.
Okay, so a lot of traders, maybe you've even tried this, get into long-term trend following. The idea is so appealing, right? You catch a huge market wave and just ride it all the way to these massive wins. It sounds like the perfect plan, but there's a catch. A pretty big and often really painful hidden cost to doing business this way.
And this right here really breaks down what that cost feels like. When you're following long-term trends, your account, your equity stream, it's just this choppy, stomach-churning ride. It's a total roller coaster. To get those big wins, you have to sit there and stomach what the source literally calls nasty losses. And here's the real kicker, the part that drives traders crazy. When that amazing trend finally tops out, you're basically expected to give back a huge piece of your profits. We're talking 10, 20%, sometimes even more. Now look at the other side. A shorter-term approach? It's just a much, much smoother journey.
So if that long-term trend following is a crazy roller coaster, what's the alternative? Well, that's where we get to the heart of it all. Let's talk about the less is more strategy.
So what's the goal here? It's simple, really. It's about being in the market less. And listen, this isn't about being lazy or missing out. No, it's about being smart, being selective. And when you do that, what happens? You get that much smoother equity stream. You get to sidestep those horrible, gut-wrenching drawdowns. And the end game? A long, smooth, and profitable run.
But does it actually work? I mean, how effective is this really? Well, get this, a lot of these short-term strategies can have a winning percentage of over 70%. Think about that. The reason is you're not trying to hit a grand slam every time. You're just hitting singles, taking small, consistent profits over and over again.
But here's where the idea gets really powerful. Let's say your strategy only has you in the market 15% of the time. Just think for a second about what that means. It means for the other 85% of the time, you're on the sidelines, in cash, safe. And while you're sitting there, you are avoiding the single biggest danger in the entire market.
So what is that danger I'm talking about? It's the one thing that every single trader dreads. Let's talk about price shocks. And the definition we're given is just perfect. It's blunt. A price shock is a large, violent, often unpleasant price move. You know what these are. These are the flash crashes, the surprise news events, the moments that can absolutely wipe out an account in the blink of an eye.
And this, right here, is the most important takeaway. The quote says it all. We can't predict a price shock, so not being in the market is the only realistic way of avoiding them. Let me say that again. You can't predict them. You can't outsmart them. The only way to protect yourself is to simply not be in the market when they happen.
Okay, so if we can't predict these things, how do we even know when the risk is high? Well, There's a warning sign. It's like the storm clouds gathering on the horizon. That sign is volatility. Let's take a look at what happens when that volatility really starts to bite.
You know, there's this old myth in trading, and a lot of people still believe it, that high volatility is great. It means big moves, big opportunities, and big money. And hey, maybe that was true a long, long time ago. But let me tell you, the game has completely changed.
All right, have a look at this chart. What you're seeing is the annualized volatility for the S&P 500 ETF, the SPY, from 2000 to 2015. The easiest way to think about this is like a storm meter for the stock market. When that line spikes up, it means things are getting wild, violent, and super unpredictable.
Now just look at that monster spike right there in the middle. You know what that is? That's 2008, the great financial crisis. Volatility went absolutely vertical, almost hitting 100%. That wasn't an opportunity for traders. That was a full-blown financial hurricane. And trying to be a hero and trade in the middle of that, it's just asking for trouble.
So this is the big shift in thinking. The modern view on volatility is totally different. Yeah, sure, you might get lucky and make some money when things are crazy, but the amount of risk you have to take on is just insane. One big loss during a time like that can put what the source calls a black spot on your record that you just can't recover from. See, smart money today isn't just chasing returns. They're looking for good returns for the amount of risk they're taking.
Okay, so this all leads to a really practical question. What do we do about it? Let's get into our final section, which gives us a simple, clear rule for managing this kind of risk.
And this really sums up the whole philosophy, doesn't it? It's all about being disciplined instead of being greedy. The advice is simple. Just be more conservative. I promise you, there will always be another trade. The market's not going anywhere. The real skill is learning to pass on the trades that can blow you up.
So how do you actually do this? Here's a really straightforward 3-step playbook. Step 1, you calculate the annualized volatility for whatever it is you're trading. Step 2, if it spikes above a certain level, let's use 50% as our example, you get out. No questions asked. Just hit the sidelines. And step 3, you wait. You just wait for the storm to pass and for things to calm down before you even think about getting back in.
And that's why this discipline is everything. Look at this quote. The winners are the ones that follow a sound, systematic approach. That's it. It's not about having a magic crystal ball or a gut feeling about the Fed. It's about having a system, having rules, and having the discipline to follow them, especially when everyone else is panicking.
So I'm going to leave you with this one last question to think about. When you look at your own trading, what are you really doing? Are you building a strategy that's designed to manage risk above all else? Or are you just chasing profit and crossing your fingers that you'll dodge the next big price shock? Really think about that, because the answer could change everything for you.
All right, let's talk about one of the biggest, most sacred rules in all of trading. It's a piece of advice you've probably heard 1,000 times, and honestly, it might be costing you a fortune. Cut your losses, let your profits run. It's the one you always hear, right? It sounds like the foundation of smart trading. But what if I told you it's also the very reason so many traders miss out on those truly life-changing gains? I mean, think about it. What if a trade just keeps going and going and going? When do you actually get out? The standard advice says you should take your profit, lock it in. But what if that's the absolute worst thing you could do? Well, for a special group of traders called trend followers, breaking that rule, that's the entire point. They don't take profits, they let them run, sometimes for years. And this is exactly how they make fortunes. So what in the world are we talking about when we say a trend? It's definitely not the daily up and down noise you see on the news. No, it's something much, much bigger and a whole lot slower. A real trend is like a massive, slow-moving wave in the market, one that lasts for months, sometimes even years. A great example? Think about a central bank's policy decisions. As the source material puts it, the movement of a central bank makes a snail look fast. Now that's slow. And those are the kinds of forces that trend followers are trying to ride. Okay, take a look at this chart of euro-dollar futures. It's basically an instrument for betting on future short-term interest rates. This is a perfect example of what we're talking about. Notice that smooth, steady climb over 30 years. Yeah, there are dips along the way for sure, but the overall direction, it's undeniable. That is a pure tradable trend. Now let's contrast that smooth ride on the left with, well, this, the S&P 500 on the right. See all those sharp, jagged movements, the crashes, the rallies?
That's what we call market noise. Trend followers, they pretty much just ignore all that. They're focused on that massive, slow-moving current you see on the left.
All right, this is where things get a little weird. Because to win with this strategy, you have to get really, really comfortable with losing. A lot. 70%. Just let that sink in for a second. In a typical trend-following system, 70% of your trades are going to lose money. 7 out of every 10 times, you're wrong. I mean, that sounds like a recipe for going broke, right? So that means this tiny little slice, the 30% of trades that actually make money, has to pay for all those losses and generate all the profit. How on earth is that even possible? The secret? It's all about asymmetry. See, when a trade goes against you, you cut it. You take a small planned loss. But when it goes your way, you just hold on. And a few of those winners, they don't just win, they become absolutely enormous, life-changingly profitable. And this brings us to the secret ingredient, the magic sauce, if you will, the fat tail. That's the name for that one incredibly rare, totally unpredictable trade that just keeps going and generates these massive returns. Without catching that fat tail, the whole strategy just falls apart. And hey, this isn't just some theory. We're talking about real-world events. Think about that 30-year decline in interest rates we saw, or gold's historic run-up to almost $2,000 an ounce, the dot-com bubble, the rise and fall of oil, the 2008 financial crisis. These were all fat tails that made absolute fortunes for the people who were able to ride them all the way. Okay, so if your entire strategy is built on catching these huge, rare moves, what's the absolute biggest mistake you could possibly make? Doing the sensible thing, taking your profits early, it feels so smart, so responsible, like good risk management. But in this specific strategy, it's total self-sabotage. You're basically cutting off your winners right at the knees before they have a chance to grow into giants. So here's the trap, step by step. You're in a winning trade, you start getting a little nervous, and you decide to lock in those gains. Smart, right? But then the trend keeps going, and your original signal to get in, that's long gone. So you have no rule, no system to get back in. You're stuck on the sidelines, just watching that fat tail, the very thing you needed to make the whole strategy work, get away from you. You've literally outsmarted yourself right out of a huge profit. You know, the source material puts it perfectly. It says profit-taking isn't really about managing your risk, it's about managing your gains, or really managing your emotions. And while it has its place in other strategies, in trend following, it's a fatal flaw. So if the secret isn't some super complex entry and exit system, what is it? Well, it's about realizing that your success has less to do with your fancy tools and way more to do with the environment you're trading in. This quote just says it all. It's the market, not the method. You can have the best trend-following system in the world, but if the market is just chopping sideways and not trending, you're going to lose money, period. So the real job, the real secret, is just finding a market that's actually trending. And look, there are different ways to do this, different flavors of the strategy, and they each have their own pros and cons. A moving average system, for example, is super responsive. It gets you into trends early, which is great, but it also gets faked out a lot, which leads to all those small losses we talked about. Then you've got something like a breakout system. It waits for a price to hit a new high or a new low. It's way less prone to that daily noise, so you get fewer trades, but they're often more reliable. The downside? When you're wrong, the loss can be bigger. And then there are methods like linear regression that try to split the difference. The main takeaway here isn't that one of these is the best, but that they all operate on the exact same philosophy. They only work if the market is actually trending. And that leaves us with one final big question. We're all taught to manage risk, to play it safe, to lock in our gains. But what if, when you're hunting for those truly historic, massive market moves, the biggest risk of all is playing it too safe? It's a really powerful idea, not just for trading, but for recognizing when to stick with a long-term winner, even when every instinct is telling you to cash out.
You've probably heard the old saying in trading, right? You can't go broke taking a profit. But what if that's dead wrong? What if sometimes the biggest mistake you could possibly make is taking that profit? Today we're going to dig into that fascinating, kind of counterintuitive idea. So let's just get right to it. The big question for this whole explainer is locking in a gain always the right move?
Well, it turns out the answer completely depends on which game you're actually playing.
See, when it comes to the market, there are really two fundamentally different ways to look at it. You've got the trend follower, whose entire philosophy is built on one thing, letting those winners run for as long as humanly possible to catch those massive gains. And then on the other side, you've got the short-term trader, who thinks that's crazy. Their mantra is to grab profits fast before the market snatches them back. Now, they can't both be right, or can they?
Okay, let's start with the long view, the big picture. To really get inside the head of a trend follower, you have to understand why they are just so allergic to the idea of taking a small profit.
And it all boils down to this one idea, the fat tail. This, for a trend follower, is the holy grail. It's that rare, once-in-a-while, unbelievably huge home run that makes up for all the little losses and then some. If you cut a trade short and take a small profit, you've just ripped up your lottery ticket to that fat tail. You've basically given up on the entire point of the strategy.
And this chart shows you exactly why. Just look at the market bottom back in 2009. Hindsight's 2020, right? We can all see March 9th was the bottom now. But imagine being there, in the moment. After months and months of the market getting crushed, would you have had the guts to buy? Would you have held on after the first little bounce? Trying to perfectly time the bottom was a surefire way to get wiped out. The only way to catch that massive, epic recovery was to have a system that just held on for the ride.
So here's the bottom line for a trend follower. A small profit isn't a win. It's actually a huge loss. It's the opportunity cost of missing out on that one game-changing, portfolio-making trade that makes the whole system work.
Okay, but that's just one side of the coin. What happens if we completely change our perspective? Let's stop looking at the big picture and zoom way, way in, right down to the minute-by-minute action.
So here we're looking at daily crude oil prices during the 2008 crash. From this far out, the trend is crystal clear, right? I mean, it's just a complete free fall. No argument there. But what's actually happening inside that huge move?
Now, this is where it gets really interesting. On the left, you see that smooth, obvious trend. But look at the right. We've zoomed in to just 3 days from that exact same period. All of a sudden, where'd the trend go? It's gone. What you're left with is this choppy, chaotic, almost random-looking mess. This is what traders call market noise.
And there's a great quote that just nails this idea. A price chart looks more like random movement as you change the resolution from longer to shorter. So what looks like a clear path from far away turns into a chaotic jungle up close. And when you're trading in the jungle, the rules of the game have to change completely.
So if you're not trying to ride some big, massive trend, how in the world do you trade this noise? Well, it takes a totally different playbook and a totally different set of tools.
The number one tool in this playbook is something called the average true range, or ATR. The easiest way to think about it is like a ruler, but for volatility. It just tells you on average how much a price tends to move around in a given day. In a noisy market where you can't rely on a trend, the ATR gives you an objective way to measure what a normal move is versus a big one.
And here's how short-term traders put it to work. Instead of just guessing where to take a profit, they use the ATR to set concrete, objective targets. A common strategy is to set 3 different targets. Maybe one at 1.5 times the ATR, another at 2 times, and a final one way out at 4 times the ATR. And as the price hits each level, you sell a piece of your position. The key is using limit orders because in this noisy, fast-moving world, a price spike in your favor might only be there for a split second.
Okay, so that all makes sense. Short-term traders should take profits systematically. So it follows that they should use tight stop losses too, right? You got to protect yourself. Well, this is where things get really weird and, honestly, pretty counterintuitive.
Listen to this quote because it really flips conventional wisdom on its head. The argument is that stop losses actually get in the way of a good strategy. Why? Because most of the time, they're based on your personal pain tolerance, how much you're willing to lose, and not on what the market or the system actually needs to breathe and work properly.
Think about it. In a noisy market, prices are constantly whipping back and forth. How many times have you been stopped out of a trade right at the worst possible moment, only to watch it immediately reverse and go your way? A stop loss takes what could have been just a temporary dip and turns it into a permanent loss. So the argument goes, if your system feels too risky, the answer isn't to slap on a stop loss. The answer is to just trade smaller. Control your risk through position sizing, not by interfering with the system itself.
But, and this is a huge but, this is not a universal rule. There are absolutely times when a stop loss isn't just a good idea, it is absolutely 100% essential. Let's take a classic pairs trade as an example. So you see two related companies like Pfizer and Merck. You notice that Pfizer stock is looking unusually cheap compared to Merck. So you buy Pfizer, you short Merck, and you wait for their prices to snap back to their normal relationship. But then, disaster. Some catastrophic news hits Pfizer. A massive lawsuit, a failed drug trial, whatever. The stock collapses. The fundamental relationship between the two stocks is now completely broken. This is where a protective stop placed way outside the normal noise is your only safety net. It's a fail-safe designed for a true black swan event, and it can save you from a mind-blowing loss.
So, after all this, what's the big takeaway? It's that there's no single, simple answer to should I take a profit. It all comes down to one thing. You have to match your tools and your strategy to the time frame, to the game you're actually playing.
Let's just break it down one last time. The long-term trend follower is playing in a world of big macro trends. Their strategy? Let profits run. Their most important tool is just plain old patience. And how do they control risk? They wait for a signal that the big trend itself is over. Now, the short-term trader lives in a totally different world, a world of micro noise. Their strategy? The opposite. Take profits quickly and systematically. Their key tool isn't patience. It's the average true range. And their best form of risk control? Position sizing. You see? Two different games, two completely different sets of rules.
So the next time you're about to place a trade, before you even think about where to take a profit or put a stop, just ask yourself one simple question. Which game am I playing right now? Am I hunting for those giant trends in the long game, or am I trying to navigate the choppy waters of the short game? Because knowing the answer, well, that changes everything.
So let's talk about something that pretty much anyone who's ever dabbled in algorithmic trading has dreamed of, the perfect system. But what if I told you that searching for perfection is actually the biggest mistake you can make? Today, we're going to break down why being robust is so much more important than being perfect.
You know, this quote is from a real conversation with a client, and wow, it just perfectly captures a feeling every trader knows. I mean, wouldn't it be incredible to get all the upside of the market with absolutely none of the downside? It's the ultimate fantasy, right? All profits, zero losses.
It's a really nice thought, but, well, as the source material points out, it kind of shows the client wasn't quite clear on the concept, because in the real world of trading, that beautiful dream can turn into a total nightmare, and fast.
And that brings us right to our first big idea, the myth of perfection. See, the whole notion of chasing a system that never, ever loses isn't just unrealistic, it's a fundamentally flawed goal. It basically sets you up for failure before you even start.
Let's just be super clear about this. A strategy that only spits out profits and has zero losses, it does not exist. It's pure fantasy. The markets are, by their very nature, uncertain, and losses are just a part of the game you have to accept. Trying to get rid of them completely, it's like trying to imagine an ocean without any waves.
Okay, so if perfection is the wrong goal, then what's the right one? Well, that leads us to our second point. The real goal is sanity. It's about finding a method you can actually live with day in and day out, which means you have to prioritize your own psychology, sometimes even over maximum profits.
This right here. This gets to the absolute heart of it. The potential profit of any system is completely worthless if the anxiety it gives you makes you bail on it during a tough stretch. Your ability to just stick with the plan through the good times and the bad is literally the most important thing.
And yep, this is the bottom line. A system might have a mind-blowing 20-year backtest, but if you can't handle the emotional pressure and you jump ship after a couple of losses, guess what? You're never going to see those amazing long-term returns. Your emotional strength is the bridge to your financial results.
All right, so how do we actually build a system that we can stick with? This brings us to Section 3, your pre-testing checklist. This starts way before you run a single backtest, and it's built on 4 absolutely essential pillars.
First, you need a sound premise, a real, logical reason why your strategy should work. Second, you have to choose a range of parameters to test, not just one magic number. Third, be realistic with your expectations. Are you aiming for slow and steady returns, or are you shooting for the moon with high risk, high reward? And finally, define your markets. A strategy that works for volatile tech stocks probably isn't going to work for stable government bonds. Get these 4 pillars right, and you've got a solid foundation to build on.
Okay, moving on to Section 4. Now that we've done our homework, we can finally run our tests. But, you know, reading the results, that's an art form in itself. This is where you really start to see the difference between a robust idea and a fragile one. So let's look at 4 possible outcomes you might see.
So case one, if every single parameter you test makes money, stop right there. I know it sounds amazing, but it's a huge red flag. It almost always means there's a mistake in your test, like you're accidentally using future information to predict the past. Nothing in trading is ever that perfect.
Now, this is going to sound weird, but if everything loses money, that can actually be fantastic news. It means your core idea is probably solid, but your execution is just backwards. You might be sitting on a brilliant strategy. You just need to flip your buys to sells and sells to buys.
And then there's this one. This is the most common and, frankly, the most dangerous trap. You run 1,000 tests, right? And 800 of them are losers. But you find this tiny sweet spot of 200 that looks incredible. This is not a robust system. It's a sign of random luck, and if you chase that sweet spot, you're heading for disaster.
This is what you're looking for. The ideal result looks like a relief map on a chart. You see this big, wide area where most of your parameter combinations are profitable, and the best results are all clumped together in the middle, kind of tapering off at the edges. That shows your idea is sound, and it doesn't depend on one single magic number. That is what robustness looks like.
So, let's say you found your relief map. Awesome. But how much can you actually trust those results? Well, that brings us to Section 5. And the answer really comes down to statistics, specifically the number of trades in your backtest.
For a short-term system, you need a pretty big sample size to feel confident. The general rule of thumb from the source is you need a bare minimum of around 400 trades. That's what gives your test real statistical weight.
And why 400? Because that gets you a sample error of about 5%, which is kind of the gold standard for an acceptable confidence level in statistics. It means you can be pretty sure your results aren't just a random fluke.
But here's where it gets tricky for long-term strategies. Think about a trend-following system. It might only make, say, 5 trades a year. So over a whole decade, you've only got 50 trades in your sample.
And with only 50 trades, your sample error balloons to 14%. That is nearly 3 times higher. At that point, trusting the results isn't really about stats anymore. It's a massive leap of faith, because the chances that it's all just random noise are way, way higher. And this all leads us to our final and honestly our most important point. Section 6, the real secret to building a trading system that lasts. It's not about finding the one single perfect setting. It's about embracing imperfection by diversifying.
This analogy is just brilliant. Think about it. When you pick just one stock, yeah, you have the highest chance for a huge return, but you also have the highest chance of a huge loss. Well, picking one perfect parameter for your system, it's the exact same risk.
So here's the key takeaway. Trading a single, optimized parameter is going to give you a really volatile, stressful ride with huge highs and crushing lows. But if you trade a small basket of several good, but not perfect parameters, say a 40-day trend and an 80-day trend together, you smooth out your results, you lower your risk, and you create a much more stable, sustainable, and frankly, psychologically manageable system.
And that really leaves us with one final question to think about. When it comes to your own trading, are you obsessed with finding that one perfect, fragile little peak? Or are you focused on building a broad, resilient, robust mountain range that can actually stand the test of time? The answer to that question will probably define your entire trading journey. Ever feel like you're playing a different game than the Wall Street giants? Well, what if you could level that playing field? Today, we're breaking down a professional-grade approach to managing risk, but we're making it simple enough for any investor to use. So let's dive right in.
It sounds a little crazy, doesn't it? $1 billion fund versus you? But here's the secret. Being small isn't a weakness. It's actually your greatest strength, your secret weapon. Let me show you exactly what I mean.
All right, so this brings us to our first big idea, the individual investor's edge. This is all about flipping the script. It's about realizing that not having billions of dollars to manage is, believe it or not, a massive strategic advantage.
And check this out. It really puts things into perspective. Those giant hedge funds, they're like massive cargo ships. Yeah, they're powerful, but they are slow to turn, and they can't get in or out of a trade without literally moving the market. That's a huge problem. You, on the other hand, you're a speedboat. You're nimble. You can zip in and out of positions without anyone even noticing, and you can diversify in ways they can only dream of.
But, and this is a big but, none of that speed and agility matters without this one fundamental rule.
Your superpower is useless if you don't have a handle on risk. This isn't just a friendly tip, it is the absolute foundation of everything. Losing control of risk is the quickest way to zero out your account, period.
Okay, so if risk is everything, how do we actually control it? Well, the answer is the core concept for this whole explainer. It's called the equal risk principle. And it's a beautifully simple but incredibly powerful way to structure every single trade you make.
And this quote just says it all, doesn't it? We're so often trained to hunt for the biggest returns, to find that one stock that's going to go to the moon. This strategy says, forget all that. Stop focusing on how much you could make and focus entirely on the risk you're taking.
So what does that actually mean? Well, equal risk trading is just what it sounds like. Every single position in your portfolio gets the same risk budget. You're not putting more money on what you think will be a winner. Instead, you're giving every trade an equal statistical shot at contributing to your returns, and you're making sure no single trade can ever blow you up.
All right, enough theory. Let's get practical. How do we actually do this in the real world? We're going to start with the place most of us are familiar with, stocks.
Now, the source material calls this the not rocket science approach, which I absolutely love because it isn't. It is so straightforward. Let's say you have a $100,000 portfolio and you want to own 10 stocks. Easy. Each stock gets a $10,000 allocation. Then you just divide that 10 grand by the stock's price and boom, you know how many shares to buy. It's a super simple way to get a portfolio that's pretty well balanced on risk.
But there is one huge flashing red light here. This whole method completely falls apart when you're dealing with really low-price stocks, penny stocks. A stock that's already crashed from $30 down to $5 is insanely volatile. Its risk profile is just off the charts, which makes it basically impossible to size correctly. So what's the solution? Just don't touch them. Avoid them completely.
So this simple stock method, it's a great start, but it's not perfect. There's a dilemma. Since you can't really use leverage easily, you can't force a really stable, low volatility stock to carry the same amount of risk as a more volatile one. So the question becomes, how do we get to a place of true risk equality across every single trade?
Well, the answer, and this is where we get really precise, is in the world of futures. This is the arena where you can achieve the kind of exact risk tuning that's just not possible with a basic stock portfolio.
And the key that unlocks all of this is a tool called the Average True Range, or ATR. Now, don't let the technical name scare you. Honestly, just think of it as a volatility ruler. That's all it is. It just measures how much a stock or commodity typically bounces around between its high and low price on any given day. A high ATR means it's jumpy and risky. A low ATR means it's pretty stable. It's our objective measure of risk.
So now that we have our ruler, the ATR, we need a target to aim for. In the professional world, a pretty standard target for annual portfolio volatility is around 12%. Now that's not some random number. It's a carefully chosen balance point between chasing solid returns and making sure you're managing your risk. It's our North Star.
And you don't need some supercomputer on your desk to figure this out. As you can see here, a simple spreadsheet is all it takes. By just plugging in your daily profit and loss, you can use a basic formula to calculate your portfolio's actual, real-world volatility. This tells you exactly how much risk you're running right now.
And once you know your current risk, adjusting is easy. Let's say your portfolio's volatility is chugging along at just 2%, but your target is 12%. Well, the answer is simple. You need to scale up your position sizes to hit that goal. The key here, though, is not to fiddle with it every single day. Just wait for a significant change in volatility, or, even simpler, just reevaluate and adjust once a month. Okay, so we've nailed how to size our individual trades. We're done, right? Not quite, because the real secret to a bulletproof portfolio goes one level deeper. And this is a game-changing concept. It's about diversifying your strategies, not just the markets you trade in.
I mean, just think back to the 2008 financial crisis. It was a brutal, brutal lesson for investors. When the panic hit, everything moved together. All correlations went to one. Stocks, commodities, you name it, it all went down. So that beautifully diversified portfolio of different assets, it suddenly became one giant losing position. Market diversification failed when people needed it the most.
So here's the crucial distinction. Market diversification is like owning stock in both HP and Dell. Sure, they're different companies, but they're in the same business and they tend to move together. Strategy diversification is totally different. That's like having one system that buys and holds for the long term and another system that bets on short-term price snaps. They are fundamentally unrelated, and that gives you much, much more powerful protection.
So how many different strategies do you need? A dozen? 20? The answer might actually surprise you. The research points to a kind of magic number, and that number is 4. You get the biggest bang for your buck, the most diversification benefit from the first 3 or 4 unique strategies. After that, you start to see seriously diminishing returns.
In fact, this is where that old saying, more is better, can get you into a lot of trouble. The belief that you should trade every market you can get your hands on is a trap. When you over-diversify, you inevitably start adding mediocre or even poorly performing assets just for the sake of it. And all that does is dilute and drag down your overall returns.
And this is a perfect example. The source calls silver a robustly bad asset. Look at the chart on the left. It kind of looks like it's trying to follow gold. But then look at the ratio chart on the right. You can see the relationship is totally unstable and has been breaking down for years. It's just a consistent loser. So the question is, why would you keep something like that in your portfolio just to say you're diversified? You shouldn't.
All right, so let's boil this all down. What are the big takeaways? First, as an individual investor, your size is your superpower. Use it. Second, think in terms of equal risk, not equal dollars. It gives every trade a fair shot. Third, true diversification, the kind that protects you in a crisis, comes from different strategies, not just different markets. And finally, be ruthless. If an asset is a consistent loser, cut it loose.
And that really leaves us with one last big question you should ask yourself when you look at your own investments. Are you actually building a diversified, resilient portfolio, or are you just diluting your best ideas by holding on to things that don't deserve to be there?
All right, so you've done it. You've poured hours into designing an algorithmic trading strategy. The logic is tight, the idea feels solid, and you're pretty sure you've got a winner on your hands. But hold on. The next step? Well, it's a minefield. This is where most brilliant ideas either prove their worth or, honestly, go to die. So let's talk about how to get through it in one piece.
You've programmed the rules, you've checked your own logic, and on paper, it looks amazing. You're feeling that rush of confidence, and hey, you should be. Getting this far is a huge accomplishment. But that confidence, it's about to face the ultimate reality check.
And this is the part we really need to focus on. It's the testing process itself, where so many promising strategies just completely fall apart. It takes an incredible amount of discipline, maybe even more than live trading, because it is just so easy to fool yourself. This brings us to what our source material calls the fork in the road. You've got these incredibly powerful computers ready to crunch numbers for you, but here's the catch. They'll give you the wrong answers just as fast as the right ones. They only do what you tell them to. And our own bias, our deep desire for this thing to work, can make us blind to some really big dangers.
So how do we get through this minefield without blowing up? Well, you need a guidebook. You need a set of rules that you just don't break. This is your framework for honest testing, and it's designed to protect you from the data and, more importantly, from yourself.
So here they are, the 7 core principles. We're going to break it down. First, more data is always better, always. Second, you have to keep a chunk of that data totally separate for a final honest check. Third, measure your results the same way every time. Fourth, space out your test parameters using percentages. We'll get to why that's so important in a second. Fifth, don't just throw 1,000 random ideas at the wall to see what sticks. Sixth, you're looking for a tough, robust system, not a perfect, fragile one. And last, and this one is crucial, whatever you do, you can't go back and tweak your system based on that final validation data. That's cheating.
Okay, so what is this percentage spacing thing all about? It's actually pretty clever. Look, if you test a moving average in equal 10-day steps, going from 10 to 20 days is a massive 100% change. But going from 190 to 200 days, that's barely a 5% bump. See the problem? This skews your results, making slower trends seem way more stable than they really are. If you use percentage-based steps instead, every jump is meaningful, giving you a much more honest picture of what's going on.
And all of this leads us to the single biggest, most dangerous trap in testing. It's called overfitting. It's the dark art of building a system that would have been a money-printing machine in the past, but is completely worthless for the future.
So what is overfitting? It's when your model doesn't just learn the music of the market, it memorizes the static, the random noise in between. It becomes so perfectly tailored to every little random wiggle in your old data that it creates this beautiful, fragile system that will absolutely shatter the second it encounters a live market.
There's this great story that illustrates the point perfectly.
A weather expert found an 18-year correlation between wheat crops in Argentina and Europe. He even came up with a logical-sounding reason for it, something about the Gulf Stream. It was consistent, it was plausible, and it was totally, completely wrong. The lesson? If you look at enough data for long enough, you'll always find a pattern. The hard part is knowing if it's real. The source material just nails it with this quote. It says, "You can always explain what happened yesterday and seem really smart doing it. But that's not the same as predicting what will happen tomorrow." And that, right there, is the entire game. This is why we have to know the difference between feedback and robustness. Feedback is when you look at your test, see a big loss on, say, May 15th, and you add a special rule just to avoid that specific loss. That is cheating. You're fixing the past. Robustness is the goal. That's about designing a system that works broadly across a whole range of parameters, one that's built to survive the future, not just to look perfect in the past. And if you want a real-world, high-stakes example, just look at the collapse of long-term capital management. You had Nobel Prize winners running this thing, but they apparently decided that some historical data showing huge losses was inconvenient, so they just removed it. They figured those events were so rare they wouldn't happen again, and their models looked fantastic with these amazingly smooth returns right up until one of those impossible events happened and completely wiped them out. This is why this stuff matters so much. There's a stark warning in the source that says it all. If you fiddle with the data, if you create special rules to dodge historical losses, then the future losses that come, they are entirely your fault. And remember, it's your money on the line. So beyond the giant trap of overfitting, there are other, sneakier dangers lurking in your data. These are the kinds of things that can totally wreck your results, and you often don't even see them coming until it's way too late. Okay, let's talk about price shocks. What are they? Think of them as these massive, wild market moves that nobody saw coming. We can define one as any day where the price range is at least 2.5 times the recent average. Now, in your backtest, these shocks are just numbers. The huge danger is that your system's awesome performance might just be because it got lucky on a few of these shocks in the past. And that's the question you have to be brutally honest with yourself about. Does your backtest look amazing because your strategy is genuinely skillful? Or did it just happen to be on the right side of a few random, unpredictable events that are never going to happen the same way again? Because one of those is a real edge, and the other is just plain luck. Then there's the whole dirty data problem. The author of our source material shares this fantastic story. He built a short-term system for trading crude oil. He ran it on this perfectly clean, pristine data from a top-tier provider, and the results were incredible, an 80% success rate. He thought he'd struck gold. But then he went live, and the reality? His first 4 trades were all losers. What happened? The clean data wasn't real. Live data feeds have glitches, bad ticks, all the noise and chaos that comes from actual humans in the trading pits. A truly robust system has to work in the real world, dirt and all, not just in a sterilized lab environment. Okay, so let's say we've dodged all these bullets. We've tested honestly. We've avoided overfitting. How do we actually measure success? And what, realistically, should we expect when we finally flip the switch and go live? Well, one of the best tools for the job is the information ratio. It's super simple. Just take your annualized return and divide it by your annualized risk. Think of it as a bang for your buck score. It tells you how much return you're getting for every unit of risk you take on, which is a great way to compare different strategies apples to apples. And now, for a cold, hard dose of reality, look at this chart. Your initial backtest results, the in-sample test, that is the best your system will ever look. Ever. When you tested on that clean, out-of-sample data you held back, you should expect your performance to drop by about half. And when you go live in the real world, well, it's probably going to drop again. So here's the rule of thumb you need to burn into your brain. Whatever amazing results your backtest shows, you should go into live trading expecting at least twice the risk and about half the performance ratio. It's a sobering thought, I know, but being realistic is absolutely key to survival. Which brings us to the final and most important question. After all the coding, all the testing, all the analysis, is the strategy you've built actually tough enough for the real world? Or is it just a beautiful illusion that only works inside the clean, predictable confines of your spreadsheet?
You know that feeling, right? You find a pattern in some data and it looks absolutely perfect. So perfect, in fact, that you build your entire strategy around it, only to watch it fall flat on its face in the real world. Well, today we're diving deep into that very temptation, the dangerous habit of beating data into submission, and how to avoid the overfitting trap that snares even the sharpest minds out there. Let's get into it. So, let's set the stage. Picture this. You're a developer. You've poured months into building a system, and suddenly, it's just not working. You're at a crossroads, and your next move is everything.
So what do? Naturally, you start digging into the data, right? You're looking at the exact moments where things went south. You're asking yourself, should I tweak the stop loss? Was the market just too crazy that day? These all sound like smart questions, but believe me, how you answer them is going to determine whether you succeed or fail.
This really is that fork in the road. One path leads to a solid, successful system that actually works. The other path, well, it looks incredibly tempting, but it leads straight into the overfitting trap, and from there, there's almost no chance your final product is going to make it.
Let's talk about that dangerous path for a minute. It's called the overfitting trap, and it's probably one of the biggest and most common mistakes you can make in data analysis and system design. So what is overfitting? It's what happens when you tweak and tune your system until it perfectly explains something that has already happened. The problem is, you're not building a general rule. You're basically crafting a perfect key for a lock that you're never going to see again. So how can you spot this trap in your own work? Well, ask yourself a few questions. Does this amazing fix of mine only correct one single mistake from the past? Does it only seem to work in one specific market? And here's the biggest red flag of all. Do the new results suddenly look, well, a little too good to be true? This chart shows you exactly what I'm talking about. Just look at that gray line, the one labeled bad results. You see that massive, sharp peak? That's the siren song of overfitting. It looks amazing, right? A huge jump in performance. But it only happens in one tiny, specific little window. You've zeroed in on one past event, but in the process, you've actually made the system worse pretty much everywhere else.
Honestly, the best analogy for this is studying for a big exam. Overfitting is like getting your hands on last year's test and just memorizing every single answer. Yeah, you'll ace that specific test if you see it again, but what happens when you walk into the real exam and the questions are different? You're toast.
Okay, so if chasing that perfect, shiny peak is the wrong move, what's the right one? Well, the solution is to embrace something a lot less glamorous, but way, way more powerful. The wisdom of the average. Let's just compare these two mindsets. Chasing the single best result feels exciting, it's glamorous, but 9 times out of 10 is just an outlier, a fluke that's never going to happen again. It builds a fragile system. The average result, on the other hand, isn't as flashy, but it's realistic, it's robust. And here's the key. The average of all your tests is the safest, most reliable forecast of how you'll do in the future.
And this just illustrates the right way to do it perfectly. Let's go back to our chart and look at the dashed line this time, the good result. See how there's no crazy spike? Instead, what you see is a modest, broad, and kind of uniform improvement across all the tests. This is a generalized fix. It's a rule that actually understands the nature of the game, not just one lucky break from the past.
And that brings us right back to our exam analogy. This approach, this is like actually studying for the test. You're learning the underlying concepts. You might not get a perfect score on any single practice test, but you're building a real understanding that will let you handle whatever the real exam decides to throw at you. That's real success.
Okay, so let's see how this all plays out with a real-world case study from our source material. We're going to look at a trading system and see just how misleading a seemingly perfect pattern can be.
The system itself is pretty straightforward. If prices go up for 2 days straight, it triggers a sell order on day 3, basically betting that things are about to reverse. Simple idea, seems logical enough. Now, let's put it to the test. So, when we crunch 25 years of data, from 1990 all the way to 2015, we see something that just jumps off the page. Look at the long trades for Monday. Across all 3 markets shown here, it's green, green, green. It looks like Mondays are just a massively profitable day to buy, consistently. I mean, this looks like a golden rule, doesn't it? Now, the temptation here is so strong, you immediately want to make a new rule. We only buy on Mondays. It seems completely obvious, but you have to ask, is this a real, repeatable pattern, or is it just a ghost in the data that happened to show up in this specific 25-year slice of history?
And this is where the whole illusion just shatters. On the left, you've got that beautiful 25-year pattern with its can't-miss Mondays. Now look at the right. This is just the most recent year from that same data set. And the pattern?
it's completely gone. Actually, it's worse than gone. Mondays were now consistently losing money. The golden rule was a total mirage.
So what's the lesson here? It's that the underlying system was actually pretty good overall, but trying to isolate that one perfect pattern, that Monday effect, was a classic overfitting trap. You just can't squeeze the data that hard and expect to find something real. You can't define these patterns with too much precision.
All of this brings us to what is maybe the single most important principle for building anything that has to work in the real, unpredictable world: the power of generalization.
And look, this isn't just for trading algorithms. This idea of avoiding those specific, fragile peaks and looking for robust, general solutions, that's absolutely crucial in machine learning, in business analytics, heck, even in how we make our own personal decisions based on what's happened to us in the past.
The source material sums up the entire winning philosophy with this quote, and it's just perfect. Success doesn't come from finding one magical trick or some perfect fragile peak. It comes from building a system where, over the long haul, across all kinds of different situations, the numbers are just fundamentally on your side.
So I'll just leave you with this question to think about. In your own work, in your investments, maybe even in your personal habits, where are you chasing a fragile, temporary peak instead of taking the time to build a truly robust foundation that can actually stand the test of time?
All right, we're going to break down the essentials of futures trading. And to do that, we're starting with a story. And trust me, it has nothing to do with charts or numbers, but everything to do with the one thing that can make or break a trader. So yeah, you read that right. What can a streaker possibly teach us about finance? Well, we're going to dive into a pretty wild story from the 1970s that sets the stage perfectly for understanding the kind of discipline you need in this game. It sounds a little nuts, I know, but believe me, this is a $1 million lesson. So our story kicks off on the trading floor of the Chicago Board of Trade. Now, if you've never seen it, just imagine a gigantic room, absolutely packed with people yelling, screaming, waving their arms. It is pure, chaotic, free market energy. But on this particular day, things were strangely quiet. The author was there with his broker, and the soybean market had already shot up as high as it was legally allowed to for the day. It's a thing called limit up, and it means trading pretty much grinds to a halt. So they're thinking about grabbing an early lunch when all of a sudden a weird noise starts from way across the massive floor. It's just a murmur at first, but then it starts to grow into a roar, and it's moving from pit to pit, getting louder and closer. The broker's gut reaction is immediate. See, in that environment, a rising wave of noise usually means only one thing: bad news. He's thinking traders are dumping everything in a panic, and the market is about to absolutely collapse. He doesn't wait to ask questions. He acts on pure, raw instinct, jumps into the pit, and just dumps their contracts to get ahead of what he thinks is a massive loss. He got out just as the noise was right on top of them. He thinks he just saved their skin. And right at that moment, the real cause of all the chaos is revealed. It wasn't a market crash. It wasn't some terrible news out of Washington. Nope. It was a completely naked person sprinting right through the middle of the trading floor. A classic 1970s streaker. You can just imagine the broker's stomach dropping. He just panic sold based on a total false alarm. He scrambles back into the pit, trying to buy back their position, but it's way too late. The brief commotion is over, and the price is right back where it was, at the daily high. And that story, as funny as it is the perfect, if a little weird, introduction to a core concept in futures, one that makes both gains and losses feel way, way bigger. And that concept is leverage. So let's talk about leverage. This is probably the single biggest difference between trading futures and trading stocks, and it's exactly where that discipline we just talked about becomes absolutely non-negotiable. Okay, check this out. With stocks, when you use margin, you're essentially taking out a loan from your broker to buy more shares, and you pay interest on that loan. But with futures, it's totally different. Margin is more like a good faith deposit. You might only put down, say, 10% of the contract's total value. This gives you enormous leverage, maybe 10 to 1. And get this, you might even earn interest on your deposit instead of paying it. Now, with all that power comes a whole lot of risk. To manage it, brokers make you keep a minimum amount of cash in your account, and that's called the maintenance margin. If your losses dip into this buffer, you get the dreaded margin call, which is basically them calling you up and saying, hey, you need to deposit more money, right now. So, how do you avoid those terrifying calls? Well, a really good rule of thumb is to only use about 40% of your trading capital for your margin requirements. That leaves the other 60% sitting there as a nice cushion, which brings your effective leverage down to a much safer 4-to-1. It gives you a buffer to handle those inevitable drawdowns, the reductions in your account from losing trades.
Okay, so managing leverage is absolutely key no matter what you're trading. And with futures, you can trade assets from all over the world. But that means you have to get comfortable with foreign exchange, or FX. And here's a little detail that can absolutely burn you if you're not paying attention. You have to know how currency pairs are quoted. Most are what you'd call normal, like the euro versus the dollar. But some, like the Swiss franc, are quoted backward. That means you have to flip the rate to figure out your position correctly. Forgetting that can be a very, very expensive mistake. But it's not just about currencies. Futures give you this incredible ability to diversify across 6 major sectors. You've got interest rates, forex, stock indexes, energy, metals, and agricultural products. And what's so cool is just how different these all are from each other. In the stock market, when things get shaky, almost everything tends to go down together, right? But with futures, you can trade assets that are truly unrelated. Think about it. The price of gold, which people buy as a hedge against inflation, has almost nothing to do with the price of copper, which is all about industrial demand and construction. Now that is real diversification. All right, let's roll up our sleeves and get a little practical. Let's see how you actually calculate your profit or loss on a futures trade. It's not always as simple as just looking at the price change. See, every single futures contract has its own unique multiplier. Let's take corn, for instance. A tiny 1-cent move in a corn contract is actually worth $50. So if the price ticks up by 2.5 cents, you're not just up 2.5 cents. You have to multiply that by the $50 factor. That's a $125 gain per contract. You absolutely have to know these specific rules for every market you trade. Okay, for our final point, we have to talk about a huge long-term risk that a lot of traders just completely ignore, and that is the markets themselves are not permanent. They can change, they can evolve, and sometimes they just fade away. Just take a look at this chart. This shows the trading volume for orange juice futures over the last few decades. You can see it ramps up, it gets super popular, and then in recent years, it just falls off a cliff. The liquidity, the ability to easily buy and sell is just drying up. So why did this happen? Well, it's not some random fluke. It's driven by real-world changes. Think about it. People have way more drink choices now. Sodas, energy drinks, you name it. And our tastes have shifted from frozen concentrate to fresh juice. These fundamental changes in what we buy directly impacted the trading market. It's a powerful reminder that no market is guaranteed to stick around forever. So the real takeaway here is that success in futures isn't about one single trick. It's about a deep understanding of a few core ideas. Having discipline over your emotions, like our broker learned the hard way, respecting the incredible power of leverage, using the unique diversification that futures offer, and always keeping an eye on the fact that the game itself can change. And that really leaves us with one final thought to chew on. Being aware of how the world around you is changing is just as critical as knowing the rules of how to trade in it today. Because when it comes to the markets, the only thing you can truly count on is change. All right, let's talk about the world of trading. There's one word that gets all the glory, all the headlines: profit. But there's this other word, one that's way more important, that just kind of gets pushed to the side: risk. Today, we are diving right into that dangerous gap between the two. And you know what? It's true. It just is. Who wants to talk about losing? It's way more fun to talk about the next big score. It's just how we're wired, right? We're built to chase the reward. And believe me, the financial world knows exactly how to tap into that instinct. But here's a thought that might flip your whole perspective. What if that constant focus on the upside, on the big win, is the very thing that leaves you wide open to a catastrophic loss? It's a question that could, and probably should, change your entire game. Just flick on the TV. You're going to hear a dozen experts arguing about whether some stock is going to double, but you'll almost never hear them seriously discuss if it could get cut in half. This endless drumbeat for profits creates a massive blind spot, and that's where disaster happens. To see just how bad it can get, we have to rewind the clock. We're going back to one of the most legendary market crashes in recent history, the dot-com bubble.
And trust me, this isn't just some boring history lesson. It's a masterclass in what happens when risk gets completely forgotten.
The late 90s. Man, the feeling was electric. You had new tech companies popping up left and right, and it honestly felt like you just couldn't lose money. Everybody was piling into NASDAQ stocks, absolutely convinced they were on a rocket ship that only went in one direction, up.
And this chart right here, wow, it just says it all. Look at that insane spike in early 2000. That's not just a line on a graph. That is the peak of human greed and optimism, the absolute highest point right before the entire floor just fell out from under everyone. So as the first few cracks started to show, what was the advice from the pros? Hold on, don't panic, it's just a little correction, a healthy pullback. But it wasn't a correction. It was the start of a long, painful, multi-year collapse. Before you knew it, boom, the market was down 50%. Your portfolio cut in half. And at this point, you can imagine what people were thinking, right? Okay, surely the worst has to be over now. They held on, praying for a rebound that just wasn't coming. And this is the psychological trap in action. After you've lost that much, selling feels like you're locking in your failure. It's so much easier to just hope, to believe the bottom has to be right around the corner. But hope is not a strategy. It's wishful thinking, and it's what separates amateurs from pros. And this is where that wishful thinking gets you. By August of 2002, the NASDAQ had tanked 85%. Just try to imagine that. Your life savings, just gone. What kind of financial plan can withstand an 85% loss? The answer is none. That is a complete and total failure of risk management. Period. So the big question is, how do you keep a disaster like that from ever happening to you? Well, it's not about being a genius who can predict the future. It's about having a rock-solid plan for when you are inevitably wrong. So let's build that playbook. Okay, this slide lays out 5 core rules for survival. This is your defensive game plan. First, every single trade starts with the same amount of risk. That way, no one loss can ever take you out of the game. Second, you diversify your strategies, not just the stocks you own. Third, you try to make all your risks equal so a super volatile stock doesn't have way more power to wreck your portfolio. And fifth, you have that master risk plan before you even think about hitting the buy button. They're all absolutely critical, but we're going to zoom in on number 4 for a second. Avoid low-price stocks, because it reveals this hidden trap that so many traders fall into. You know, a low stock price, it can seem like such a bargain, right? A huge opportunity. But more often than not, it's actually a giant red flag. And to understand why, we need to talk about something called volatility. Now, this chart tells a really powerful story. The gray line is Bank of America's stock price, and the black line is its volatility. Now, watch what happens during the 2008 financial crisis. As that price absolutely plummets, what does volatility, the risk, do? It explodes. It goes vertical. So what even is volatility? Let's keep it simple. It's just a measure of how wild and crazy a stock's price swings are. Low volatility is like a calm, predictable river. High volatility, that's a Category 5 hurricane. It's chaotic, unpredictable, and incredibly dangerous. So here's the bottom line, the key takeaway. Stocks with low prices, especially ones that have just crashed, tend to have sky-high volatility. That is the danger zone you want to avoid. What you're looking for is this safer zone, stocks with more predictable, manageable risk, and those are often the ones with higher, more stable prices. And that really says it all. Sure, you could make money in those hurricane conditions. People win the lottery too, but the potential reward simply does not justify the insane risk you're taking. The odds are just terrible. The smartest, safest move is to just stay on the sidelines. Okay, so let's take all this theory and apply it to a situation that every trader absolutely dreads. A drawdown. This is where the rubber meets the road and the pressure is on. Put yourself in this scenario right now. You have a hard and fast roll. You will not lose more than 20% of your account. But right now, you're down 15%. You are staring right over the cliff's edge. What's the pro move? You've basically got 3 choices. You could double down, which is a pure gambler's move and, frankly, insane. You could just keep trading like normal and pray that the next trade is a winner. Or you can scale back. And right there, that's it. That is the only real option for a professional. Your number 1 job is survival. You have to reduce your position size. You cut your leverage. You do whatever it takes to make sure you can live to trade another day. The goal isn't to be a hero, it's to save your account. But cutting back is only half the job.
You also need a super disciplined plan for getting back in the game. You don't just jump back in with both feet on the first green day. No, you wait for a solid recovery, you wait for a small, healthy pullback, and then you slowly, carefully add some of that leverage back. It's patient. It's professional. And that really brings us to the final and most important question of all. Look, anybody can have a plan for making money. That's the easy part, the fun part. But the true test of a trader, the real key to surviving long-term in this business, is having a clear, disciplined, and unbreakable plan for what to do when you're wrong. So, do you?
You ever feel like you're trying to find a needle in a haystack, but the haystack is, thousands and thousands of stocks, and that one needle is the secret to actually beating the market? It feels impossible, right? Well, today we're going to dig into a surprisingly simple method that might just flip the way you think about picking stocks entirely.
And that really gets us to the heart of it, doesn't it? To win this game, do you need some brilliant, super complex formula that tries to predict every little market move? Or is the answer just a simple rule? The answer is, well, it's probably not what you think.
So here's the thing we all face. Most of us don't have unlimited cash to just buy up the whole market. We have to pick and choose. And the goal, of course, is to build a small portfolio of stocks that's going to do better than average. Hopefully a lot better. But how on earth do you find those winners?
Okay, so what's our first instinct? It's usually to try and outsmart the whole system. The story behind this method actually starts there, with someone trying to build a fortress of complex math, meticulously tweaking trades, and wrestling with past data to create what looked like the perfect portfolio. The dream, as you can see, was this beautiful, steady line just going straight up. On paper, it looked like a sure thing. Yeah, so about that sure thing, reality had other ideas. When this so-called perfect model was let loose on fresh, real-world data, it just completely fell on its face. The performance was a total disaster. This is a classic trap in data science, and it's called overfitting. Think of it like this. It's like a student who crams by memorizing the answers to last year's final exam. Sure, they might ace that specific test, but they haven't actually learned a thing. The model had just memorized the past. It was clueless about the future. And this is the big takeaway. You just cannot strong-arm the market into doing what you want it to do. It doesn't care about your beautiful spreadsheet or your elegant formulas. The market is going to do what the market is going to do. And trying to force it to fit your perfectly crafted plan is, well, it's just a recipe for failure. Okay, so if that perfectly tailored, tight-fitting approach is a bust, then what actually works? Well, this brings us to a wonderfully simple and honestly pretty powerful idea, the loose pants philosophy. I know it sounds a little silly, right? But think about it. A pair of loose pants can fit a whole bunch of different people. They're adaptable, they're flexible, and that's exactly what an investing strategy should be. Instead of creating this perfectly tailored system that only fits the past, we need something looser, something that can actually handle the wild and unpredictable swings of the real market. And if you need a visual for why that flexibility is so critical, this chart says it all. Just look at the blue line on the left, before 2008. It's a pretty steady, almost predictable climb, right? A complex, rigid model would have been designed to fit that pattern perfectly. But then, look what happens after 2008. The pattern just shatters. It's chaotic. It's erratic. Any model that was perfectly tailored to the before would have been absolutely useless in the after. Okay, so we need a loose, simple approach. I get it. But what does that actually look like in practice? Let's dive into the nuts and bolts of a really simple ranking method. And honestly, here it is, in all its simple glory. Step 1 is just a basic filter. If a stock has lost money over the last 2 years, just get rid of it. We're just making sure we're dealing with companies that are at least fundamentally afloat. Then, step 2 is where the magic is. You take what's left and you rank them based on one thing and one thing only: how well they've done over the last 3 months. We're just riding recent momentum. That's it. 2 simple steps. Now, this slide is so important because it shows the big temptation, right? You look at profit on the left and it feels too simple. Then you look at the right and see all these fancy-sounding things: returns divided by risk, equity smoothness. I mean, who doesn't want to avoid drawdowns? But here's the trap. Every single one of those conditions you add, it's like tightening the pants. You start overfitting all over again, trying to jam the market into your perfect little box. And we already know how that movie ends. Now, we do need a quick reality check. This method is all about outperformance, and that usually comes with more volatility. It just does. So what does that mean for you? It means you should be ready for bigger wins when the market is up, but you should also be prepared for bigger losses when it's down. It's just the nature of the beast when you're hunting for those higher returns. But hey, picking the stocks, that's really only half the job. The market is always changing, which means your portfolio has to be able to change right along with it. And that's where this idea of rotation comes in.
This is just so crucial to remember. The hot stocks from last year probably aren't the hot stocks today. Things change. A portfolio is not a set it and forget it kind of thing. If you want to have success over the long haul, that portfolio has to be alive, dynamic, and ready to adapt.
So how do we stay nimble without falling right back into that complexity trap? You guessed it. We use another simple, elegant rule. And this one's called the 10-15 rule. Okay, so here's how this works. It's actually genius. Your portfolio is made up of the top 10 ranked stocks, your champions. Every day, you rerun the ranking on a bigger pool of stocks. Now, you don't want to freak out and sell every time a stock has a little dip, so you create a buffer zone. As long as your 10 stocks stay in the top 15, you do absolutely nothing. But the very moment one of them drops to rank 16 or lower, it's out. You sell it, and you replace it with whatever the new number 1 ranked stock is that you don't already own. It's a simple, unemotional, rules-based system to keep your portfolio full of the market's current leaders.
So this whole journey we've been on, from a super complex failure to a really simple success, it leaves us with one final thought. We've seen how, in the ridiculously complex world of the financial markets, a simple, flexible approach can be way more powerful than a rigid, complicated one. So the question I want to leave you with is this: where else could that be true? Where else in our lives are we making things way more complicated than they really need to be? Have you ever had one of those trading strategies that feels like absolute magic one month, and then the next it just completely falls apart? It's so frustrating, right? But what if I told you the problem isn't actually your strategy? What if it's the market you're using it in? Well, today, we're going to learn how to read a market's unique personality so we can match our approach to its specific character. So let's just get right to the heart of it. You've seen it. Some markets just seem to march forward with this incredible purpose in one clear direction. And others, well, they kind of stumble around like a drunken sailor, you know? They take 2 steps forward, 1 step back, another to the side. And really, understanding this one core difference, that's the key to unlocking more consistent trading. So what you end up with are these 2 totally different market environments. On one side, you've got that smooth, directional trend. It's clean. On the other side, you have all this noisy, choppy action. It's like a battlefield where no one's really winning. Now, if you try to use the exact same playbook in both of these worlds, you are just setting yourself up for a world of pain. So how do we actually tell them apart? I mean, we can't just eyeball it and guess, right? We need a real objective tool to measure the stuff. And that brings us to the key that's going to unlock this whole thing for us. A way to actually put a number on a market's noise level. It's called the efficiency ratio. And don't worry, this isn't some crazy complex formula. Just think of it like a simple score for how direct a market is. You know, if a market gets from point A to point B in a nice straight line, it gets a high score. It's efficient. But if it wanders all over the map to get there, it gets a low score. It's inefficient. It's really as simple as that. And if you're curious how it actually works under the hood, it's super intuitive. First, you just measure the net change in price. That's the straight line distance from your start point to your end point. Then, you divide that number by the total path it traveled to get there, adding up every single little up and down move along the way. See? A straighter path naturally gives you a higher score. And that brings us right back to our sailor. The source material puts it perfectly. That inefficient, wandering path is the ideal setup for what's called a mean reversion strategy. Basically, you're betting that after a big lurch in one direction, it's going to snap back to the average. You fade the move. But for those efficient, straight-line markets, you do the exact opposite. You go with the move. That's trend following. Okay, so this all sounds great in theory, right? But does it actually hold up in the real world? Let's put it to the test. We're going to start by applying this exact ratio to the stock market and see what kind of personalities we can dig up. And wow, the results are just fascinating. What you're looking at here is a chart of stocks sorted by their efficiency score. Take a look over on the left. These are the stocks with the highest scores, meaning they have the strongest, cleanest trends. You see names like Twitter, Netflix, Google. Now let your eyes drift all the way to the right side, to the lowest scores. What do we find? The old guard, right? ExxonMobil, American Express. The data paints a super clear picture, separating those high-tech movers from the noisier blue-chip grinders.
To really see this in action, let's zoom in and put the two extremes from our chart right next to each other. We're talking about the high-flying, trend-heavy Netflix versus the steady, massive, and more range-bound ExxonMobil. And here it is, the visual proof. This chart just perfectly illustrates what that efficiency score was telling us. Look at Netflix in blue. You see these incredible, powerful bursts of movement, right? It just goes. Now look at ExxonMobil in orange. It's a textbook example of what they call alternating up and down days. That right there is the picture-perfect definition of a noisy, choppy, inefficient market. Now, what's really cool is that this whole approach works even better for broader markets. Think about it. A single stock's personality can get a total makeover overnight because of an earnings report or some news. But bigger things like ETFs and entire futures markets, their character tends to stay very consistent for long periods of time, which makes them much more reliable to analyze this way. So let's expand our view and look at the futures markets. This covers everything from interest rates to currencies to commodities. And just like we did with stocks, when we sort these markets by their efficiency score, a really clear pattern of different personalities just pops right out. Over on the far left, with the lowest noise and highest efficiency, you find short-term interest rate markets. And that makes total sense, right? They tend to move very smoothly in one direction, mostly just following what the central banks are doing. But then look all the way over to the far right, where the most noise is. What do you see? Broad stock indexes like the S&P 500. And again, that's logical. With millions of different people buying and selling for a million different reasons, the price action is naturally going to be much choppier and more likely to revert back to the average. Okay, so we've figured out how to identify a market's personality. We have a tool to actually measure its noise level. So now for the million-dollar question. How do we turn all this insight into a simple, actionable rule that we can actually use? It really all boils down to this, and it's so powerful. For those low-noise, efficient markets, the ones that move in those beautiful straight lines, your best bet is a trend-following strategy. You just want to jump on board and go with the move. But for the high-noise, inefficient markets, our drunken sailors, you do the exact opposite. You use a mean reversion strategy. You sell the big rallies and you buy the big dips, always betting on a snapback to the average. So the huge takeaway here is to stop trying to force your favorite strategy onto every single market. Instead, you need to listen to what the market is telling you about its own character. And now that you know how to read its personality, the only question left is, which conversation are you going to start first?
You know, the term algorithmic trading, it sounds pretty complex, right? Maybe even a little intimidating. But what if I told you that building a trading strategy is a lot like building a house? You'd never start without a solid blueprint. Well, in this explainer, we're going to walk through that blueprint step by step to really understand what it takes to create a trading algorithm that's actually designed to last. So, yeah, what does it really take? Because let me tell you, it's not about some secret formula or just being a whiz at coding. It's really about a series of very deliberate, well-thought-out, and well-tested decisions. And that's exactly the journey we're about to go on.
All right, Section 1, a trader's blueprint. Just like an architect, before a single trade is ever placed, the strategy has to be designed. This is the big picture phase. And for our example, we're going to focus on one of the most foundational strategies out there.
We're going to look at a total classic, trend following. The whole idea is actually pretty simple, but it's incredibly powerful. You're basically trying to ride the big, underlying waves in a market, you know, the major moves, while doing your absolute best to just tune out all that chaotic, day-to-day noise from the news headlines.
Now, building a strategy means making some really critical choices way before you write a single line of code. I mean, think about it. How are you going to spot a trend? What are your exact rules for getting in and getting out? How will you manage your risk? As you can see, every single one of these decisions is a vital piece of a much larger puzzle, and they all have to fit together just right. So, Section 2, picking your trend tool. This is our first major design decision. We have to choose the engine for our strategy. How are we actually going to identify a trend in the first place?
Okay, so there are basically three main tools in the trend following toolkit. You've got the moving average, the breakout, and linear regression. You can think of them as different lenses for looking at the market. They're all trying to do the same thing, find a trend, but believe me, each one has a very different personality and its own kind of risk profile.
Let's just compare two of the most popular approaches. First, you have a moving average strategy.
It looks at the average price over a certain period to smooth things out. Now, this strategy often has a lower win rate. Maybe only 30–35% of trades are profitable. But, and this is a big but, the wins tend to be way bigger than the losses. Then you have a breakout strategy. This is where you buy when the price breaks above a recent high. This can give you a much higher win rate, but your initial risk on any single trade can be pretty darn big. See, there's no one best answer here. It's all a trade-off, and it really depends on how much risk you're comfortable with.
And that third option, linear regression, well, that's a more mathematical approach. Imagine drawing the best fit straight line right through the recent price data. When the slope of that line starts pointing up or down, that's your signal for a potential new trend. It's just another perfectly valid way to solve the same problem.
Okay, so you've picked your tool, you've got a basic idea. Now comes what is, without a doubt, the most critical phase of all, testing. This is where an idea either proves it has potential or it gets sent right back to the drawing board.
I mean, that's the million-dollar question, isn't it? An idea can feel absolutely brilliant in your head, but the market? The market is the ultimate judge, and it doesn't care how smart your idea sounds. The only way to find out if you've got something real is to rigorously test it against historical data, and you've got to do it the right way.
So here's the secret to a good test plan. You don't just test one setting. No way. You test a whole range of them, say from a 40-day trend all the way up to a 120-day trend. And you test across all kinds of different market conditions, bull markets, bear markets, and those awful sideways markets. A healthy sign isn't that every single test is a home run. What you're really looking for is a big cluster of profitable results. If the 80, 90, and 100-day settings are all working pretty well, you've probably found a robust concept, not just some random fluke.
And this is the golden rule. You cannot fix a broken concept with a bunch of fancy add-ons later. The core idea, that simple buy and sell rule, it has to be profitable on its own. If it's not, no amount of tweaking or optimizing is going to save it. You have to go all the way back to the beginning and rethink your entire approach.
Okay, let's say our core idea passed that first test. Great. But now we're entering a very tempting and also a very, very dangerous stage, trying to make it better by adding new rules. This is where we run into the biggest trap in system design.
So let's run an experiment. We've got our breakout strategy. We start thinking, maybe I can improve this thing by adding a rule, like a trailing stop loss to protect my profits. I mean, it sounds like a perfectly logical, smart thing to do, so we run the numbers.
And boom, we get a result that looks something like this heat map. Each little square here represents a different combination, a trend period on the side and a stop loss size on top. The greener the square, the more money that specific combo made in the past. It's a really pretty picture, right? Just full of all these promising green spots.
Looking at that map, the temptation is it's overwhelming. Your eye goes straight to that one super bright green square that made the most money historically, and you think, that's it. That's the one. That's the secret setting. So you decide to build your entire system around that one seemingly perfect result. But is that really the right move?
Well, the hard reality is that single best result was almost certainly just a statistical fluke, a random outlier. The probability of that exact same thing happening again in the future is incredibly small. By chasing that one perfect setting, you've walked right into a trap.
And this trap, it has a name. It's called overfitting, and it is the #1 killer of trading strategies, period. It's when you tailor your system so perfectly to the past that you haven't actually designed a robust strategy at all. All you've done is perfectly model the random noise of the past, which makes your system brittle and extremely likely to fail in the future.
And listen, this isn't some one-off problem. Check out this test of a completely different rule. This one's a volatility filter. And what do you see? The exact same pattern. A few bright green spots of apparent perfection, surrounded by a sea of so-so results. The source material is crystal clear here. These results are finely tuned and not robust. It's the same trap, just wearing a different disguise. It looks good on the surface, but it's an illusion.
So if chasing that perfect result is a trap, what's the solution? Well, this brings us to our final and most important section. We have to adopt a philosophy of robustness. It's a total shift in thinking that separates the systems that survive from the ones that blow up. This slide really lays out the two different paths you can take. The fragile system, that's the one built on that one perfect setting. It's overfitted, it's brittle, it's unpredictable, but the robust system is completely different. It's not built on the single best outcome. No, it's built on the average of many good outcomes. It's realistic, it's diversified, and it's far more likely to adapt to a future that, let's be honest, is never going to look exactly like the past.
And this gets us to the core principle of this whole thing. The goal is not perfection, it's diversification. So instead of relying on one perfect trend period, a robust system might use 3 different ones at the same time. Instead of optimizing for just one market, you find parameters that work reasonably well across a bunch of them. You have to shift your expectation away from that best-case fantasy and toward the realistic, average return of a diversified approach.
And that leaves us with this final critical question. When you're designing a strategy, what is your true goal? Are you chasing the illusion of a perfect past? Or are you building a robust system that has the resilience and the diversification to actually survive an uncertain future? The choice you make there, well, it's everything.
Ever wonder what it really takes to build an algorithmic trading strategy? I'm not talking about the hype, but the actual nitty-gritty process of testing, refining, and creating a system that works. Well, you've come to the right place. Today, we're going to do just that. We are going to walk through a complete case study and build a strategy step by step right from scratch. So, here's our game plan for today. First, we'll dive into why intraday trading is such a unique challenge. Then, we'll map out the key decisions you have to make. After that, the fun begins. We'll test a core strategy, tweak our formula based on what the data tells us, and finally, we'll pull back the curtain on the complete optimized system. Okay, first things first. We need to really understand the arena we're stepping into. See, intraday trading isn't just long-term investing sped up, no way. It is a completely different animal with its own playbook and its own dangers. I mean, this slide says it all, right? You've got long-term investing over here, which is all about riding these big, slow-moving economic waves. It's a patient game. But then you have intraday trading, and the focus completely shifts. It's no longer about the big picture, it's about what the source calls market noise. It's fast, it's chaotic, and it becomes a tactical battle of you against everyone else in the market, right now. And in this high-speed world, tiny little details become absolutely huge. For a long-term investor, a few pennies on a commission, that's just a rounding error. Who cares? But for a day trader, someone who's in and out of the market multiple times, those tiny costs can literally be the difference between a winning system and a losing one. Every single tick matters. So, with all these challenges, where do we even begin? Well, you start by making a series of smart, testable choices. This isn't about searching for some magic formula somebody's selling online. It's a process of scientific discovery. The strategy we're going to build is a real classic, the volatility breakout. The main idea is actually pretty simple. You measure how much the market's been bouncing around lately. That's your volatility. Then, if today's price suddenly breaks out beyond that normal range, either up or down, you jump on board, betting that the momentum is going to keep going. But, just having the idea isn't enough. Turning it into a real working strategy is all about the details. We've got to answer some really crucial questions. Think of these as the dials on our trading machine that we need to tune just right. Do we hold overnight? Do we only trade with a bigger trend? And a big one, when do we take our profits and run? Let's go find some answers. All right, it's time to get our hands dirty. We're running our very first experiment on the E-mini S&P futures, using data going all the way back to 2005. Let's see if we can find some core settings that give us a profitable foundation to build on. So the central question for this first test is pretty straightforward. What's the perfect combo of how far back we look to measure volatility, and how big a price move do we need to see before we pull the trigger on a trade? Okay, so what are we looking at here? Think of this grid as a map. Each little square is a different combination of our settings. Green means profit, red means loss. See that pattern emerging? If your breakout factor is too small, say under 0.5, you're just trading noise and losing money. But if it's too big, you're also losing, probably because you're getting in right when the move is about to die. The sweet spot, that beautiful cluster of green, is right there in the middle. And boom, the data gives us a clear winner. Our first test points directly to a 30-day lookback for volatility combined with a breakout factor of 0.625. This is our baseline. This is our starting formula. But we're not done. Not even close. A good strategist knows that a baseline is just that, a starting point. The real question is, can we add a few more rules to make it even better? Let's head into the refinement phase. So our first refinement test tackles a classic trading idea.
taking profits. Instead of just waiting for the market to turn against us, should we have a rule to get out once we hit a specific profit target?
Let's see what the data says. Here we're testing different profit-taking levels, which you see in the columns, against a rule that stops us from trading when the market is too volatile, which are the rows. And what's really interesting here is that trying to avoid volatility doesn't help at all. In fact, the strategy loves it. But now, look at those columns. As you move from right to left, adding a profit target almost always improves performance up to a point.
And the best of the bunch is a profit-taking factor of 1.25. The big takeaway here is that for this strategy, it literally pays to get out while you're ahead. You reduce your risk by spending less time in the market, and in this case, it actually boosts your total return. It's a win-win. Okay, so this next test, this one feels like a complete no-brainer. We all know the stock market generally goes up over the long term. So it just makes sense that if we only take trades that go in the same direction as the bigger trend, our results have to get better, right? And here we have a perfect example of why you have to test everything and assume nothing. Just look at this chart. The bars show the results using different trend filters. But look at the tallest bar, the one that made the most money. It's all the way on the right, and it's labeled 0. And 0 means, you guessed it, using no trend filter at all.
So the huge lesson here is that for this specific system, trying to be clever and follow the trend actually hurt our bottom line. The raw signals, both buying and selling, just plain made more money. This is such a powerful reminder to let the data be your guide, not your gut feelings. Well, we've run our tests, we've crunched the numbers, and we've definitely uncovered some surprises along the way. Now it's time to put all of our proven pieces together and unveil the final optimized strategy. And here it is. Our systematic step-by-step process has given us a very clear set of rules. Number 1, use a 30-day volatility period with a breakout factor of 0.625. Number 2, take profits with a factor of 1.25. Number 3, our big surprise, do not use a trend filter. And finally, by not having a rule to exit at the end of the day, this strategy allows winning trades to be held overnight, which can capture some of those bigger moves.
And this chart, this is the result of all that work. This shows the hypothetical profit curve of our system going back to 2005. The blue line, which takes both long and short trades, makes more money overall. The orange line, which only takes the long trades, is a much smoother ride. It's a perfect picture of that classic trade-off between maximum returns and lower volatility. Now, to bring this down from the clouds and see what it actually looks like in practice, here are the signals on a real price chart. You can see the entry, that BO up for breakout up, and then a little later, the exit signal, PT long for profit target long. This is our system, doing its thing bar by bar.
You know, when you really boil it down, this entire process proves one thing. There are no magic indicators or secret settings. As the source material puts it, success here isn't about luck. It's about a rigorous, disciplined process of testing and refining. It's just achieved by hard work.
We've built a really solid foundation here, but the truth is the process of refining a strategy never really ends. So I'll leave you with just one final question to think about. Now that you've seen how it's done, if you were to take this research to the next level, what variable would you test next?
Algorithmic trading, it can seem like this incredibly complex black box, right? All code and chaos. But what if we could boil it all down to its core principles? Well, in this explainer, we're going to do just that. We're going to break down what makes a winning strategy into a clear, powerful framework. So let's dive in.
I love this quote from the source because it really sets the stage for what we're doing here. We are cutting through all the noise, all the fluff, to focus only on the ideas that have a real impact. We're getting right to the fundamentals of what makes a strategy successful.
And to guide us, we're going to use a really simple metaphor, building a house. A truly great trading strategy is a lot like a well-built structure. It needs a solid foundation, a clear blueprint, and of course, precise execution. You get those 3 pillars right, and you'll build something that can actually stand the test of time.
So let's start with that all-important foundation. Before you even think about writing a single line of code, you have to answer 2 huge questions. What is the whole point of the strategy, and how does it actually fit with you personally?
A winning strategy is really a mix of 2 things: a smart, logical idea, that's the premise, and a deep reflection of you. Are you someone who wants to be in and out of trades quickly, or are you a long-term trend follower? Can you stomach those big drawdowns?
You know, those gut-wrenching periods when your account balance just keeps dipping. Because if the strategy doesn't mesh with your personality, you're just not going to stick with it when things get tough. And trust me, they will.
Okay, with our foundation firmly in place, it is time for the blueprint. This is where we get into designing the actual rules of the system. And you might be a little surprised to find out that the core principles are all about simplicity and strength, not complexity.
The source material is crystal clear about this. More often than not, complexity is the enemy. Why is that? Well, think about it. A strategy with just a few clear rules is easier to understand, it's less likely to be overfit to past data, and it's just going to be way more robust when you're trading live. A super complex system might look incredible in a backtest, but it often just falls apart in the real world. Simplicity is what endures.
This really shows you how to build that simple, strong blueprint. Each rule should be like a load-bearing column. It needs to be strong all by itself. The strategy as a whole should work across lots of different stocks and over long periods of time, not just under some perfect, cherry-picked conditions. And using multiple parameters helps you avoid that classic trap of curve fitting, where you basically just tweak your system until it looks perfect on old data, making it useless in the future. It's all about building for resilience.
All right, on to our third and final pillar, execution. This is where the blueprint meets reality. These are the practical, in-the-moment decisions about risk, about taking profits, and about managing your portfolio that are, at the end of the day, going to determine whether you succeed or fail.
This is such a critical point. Whether you take profits or let them run completely depends on your strategy's premise. If you're a short-term trader, your whole game is about consistently grabbing small wins. But if you're a trend follower, cutting your winners short is pretty much the biggest mistake you can possibly make. The real key is knowing which game you're playing from the start.
Okay, let's talk about risk for a second. Every trader's absolute biggest fear is that sudden, out-of-nowhere market crash, right? A catastrophic price shock. The source poses this question: what is the single most effective way to avoid it? Have a think about it for a second.
And there's your answer. It's so simple, but it's also profound. Sometimes the absolute smartest trade you can make is no trade at all. If your system's rules are telling you to sit on the sidelines, then you are 100% protected from a market crash. Managing risk isn't just about fancy stop losses. Sometimes it's about having the discipline to just sit out.
Here's another really important distinction when it comes to managing risk. We've all heard about diversifying across different stocks or markets, but the source makes a fantastic point that true diversification comes from running multiple, uncorrelated strategies. So for example, you might have a trend-following system for commodities running at the same time as a short-term mean reversion system for stocks. That kind of setup is just so much more robust.
So here are a few final rapid-fire rules for execution. First, use stop losses for what they're meant for. Genuine disasters, not normal market swings. Second, you have to be disciplined. If a system just isn't working on new data, don't try to endlessly fix it, just move on. Third, learn to recognize when the market is so volatile that the risk just isn't worth the potential reward. And finally, keep your position sizing simple. Equal weighting works great. It's all about being pragmatic.
So, we've covered the foundation, the blueprint, and the execution, but there is one final, absolutely crucial piece that ties this whole thing together. And it has nothing to do with rules or with code. It has everything to do with you.
The source gives a critical warning here. You know, it is so easy to read about some amazing new strategy in a book or online, but you have to remember, people are always going to showcase their best results. You're seeing the highlight reel, not the full messy reality.
And this right here is the ultimate takeaway. It doesn't matter how great a strategy sounds on paper. You cannot and should not trust it until you have rigorously tested it yourself across different markets, across different time periods. That independent validation is the only way you will ever know its true character and, more importantly, whether it's truly right for you.
So I'll end with this. These principles, they give you a powerful framework, but they are not a magic formula. They are a guide for you to build, to test, and ultimately to take ownership of your own success. At the end of the day, it's your capital on the line. So the final question is, are you ready to do the work and build your own winning strategy?